good you liked it and all that.
Competition में पता नहीं लगा.
Yeah, that was the beauty. I was just like, just kept my mouth shut, but I was just like, fantastic. Hats off to you and the full team, man.
बहुत मेहनत करी भी और आगे देखना क्या क्या आने वाला. And we borrowed equipment from time. All second-hand equipment.
Aditya Birla Sun Life AMC since last 18 years.
The fantastic job that the team has pulled off.
Aditya Birla Sun Life AMC के साथ
जैसे कहते हैं ना कि वो टटीरा वाले की चाय ले लिया.
मैंने अपना कैरियर
किसी का स्टेप नहीं और किसी का कुछ ले लिया. People can hear us now. Get back to what people will think. What do we do apart from gossip?
It's 16 years now.
Farhan, we are live.
I'm associated with ABSL AMC since 2007.
I don't know, videos
Scheme
to
management
playing.
has gone through n numbers of changes. The number of schemes have expanded hugely, and Birla Mutual Fund as a fund house has become far more efficient than what it used to be 25 years back.
Customer got mature for a longer period.
Aditya Birla is top in technology adoption, so we have benefited a lot.
I suggest mid-cap as the best fund because I insist on the customers to stick to 10 plus years. So 10 plus years, it's always the mid-caps have done well.
I'm a very strong believer of asset allocation because what we understand is that 90% of the investor returns are depends on asset allocation. I prefer asset allocation products from Birla AMC with the names like Birla Sun Life Equity Hybrid Fund 95, which has got a very long track record of delivering consistent returns with low volatility. And there's another product from a Birla stable called Birla Sun Life Balanced Advantage Fund. So these are the two products that are my favorite.
Physical event of Voyage I haven't participated, but last year I guess it was a digital event and I have gone through it and the content was very good. Very good speakers, very good topics.
It is a really very nice way presentation of market scenario. It is a really good one.
I'm from Nasik, so we love Kumbh Mela. So I can call the voyage as a Mahakumbha of knowledge, which comes every year, and we are eagerly waiting every year for this event.
Hello and welcome to day 2 of Aditya Birla Sun Life Mutual Fund presents Voyage 2021, the rise of a new decade, partnered by ET Now. Now, the pandemic has not bogged us down, and this 8th edition of Voyage is in fact its second digital version held in FY 2021. The events of the last year have left an indelible mark on everyone. But the future is promising, which is why our theme this year is the rise of a new decade. Just like yesterday, we have a stellar lineup of speakers for you here today, along with some fun contests and interesting quizzes. Just like yesterday, the person sending the most number of relevant tweets daily wins the prize for being the smartest Twitterati of the day. Remember, yesterday's winner tweeted 322 times. That's a high number to meet, but I'm sure you guys can do it today. The person asking the most number of relevant questions or putting in the most relevant comments will be declared active learner of the day. And we have a very unique champion of the 8th Wonder contest as well. Do remember to use the hashtag Voyage2021 to reach out to us and also tag us at @ABSLMF. Now, our first speaker is a 1987 batch Odisha cadre IAS officer who is here to talk about how strategic divestments can fuel the engines of growth, a very pertinent topic in the current scheme of things. Please welcome Shri Tuhin Kanta Pandey, Secretary of the Department of Investment and Public Asset Management at the Finance Ministry of the Government of India, and he will be in conversation with ET Now's Managing Editor, Nikunj Dalmia. Hi, Mr. Pandey. Yes, Nikunj.
Nikunj, you are on mute.
Yes.
Yeah.
Well, thank you very much. Trust me, when I was on mute also, I was saying all the nice things, sir. So the mute happened by default. But gives me great pleasure to welcome Mr. Pandey on the show. And I can tell you that the DIPAM, this entire department, this entire team right now is working 24/7. I've been told that they start early, they wrap, there are no office hours, and that's largely because of the kind of good work the department and the DIPAM is doing. The disinvestment target, which we all know, which has been shared by the finance minister, clearly means that this is one space, privatization is one space where indeed lot of engagement and lot of strategic decisions will be taken. Mr. Pandey, what a pleasure to have you on ET Now. Thank you for joining us.
Thank you. It's a pleasure.
Budget, in a sense, has really raised the bar of expectations and hopes of high delivery. Are you feeling nervous?
No, I'm not feeling nervous because I think it's a very exciting budget and it really unveils a very new, bold new policy of the government, the privatization policy. And I think this policy is, I would say, is probably would like to complete the 1991 big opening that was taking place. I think for the PSCs, this would be akin to 91, the new policy.
How exactly the disinvestment program for FY22, sir, is likely to start? Will it be maximized in the first half or the second half?
I think it will be on continuous basis because I think a lot of transactions have been actually named by Honorable Finance Minister in her budget speech, including quite unusually actually that even the specific transactions have been mentioned, which we are going to close in 21-22. And of course, the work began early on and we had COVID setback, but back on track now. And I think those will be taken to logical culmination. So they will come on, in different periods, in the first quarter, in the second and the third and the fourth, and we have our plan ready.
Mr. Pandey, the naysayers would say that intent is right, but execution and process is something which always will be a challenge because it's never been easy for the government to privatize PSUs because there are multiple challenges on the labor front, on the process front. How would you simplify that?
Well, I think this privatization has to be, achieved within the economic and socio-political context that we are in, and the challenges we face and the challenges we address. So there's no shying away the fact that it is a difficult task, but all the difficult tasks also have been achieved and will be achieved.
The number which the finance minister shared, Mr. Pandey, when she was presenting the budget, how have you arrived at that number? Did you look at market dynamics, market valuations to arrive at that number, or that number is a ballpark number?
No, I mean, there is a fair amount of detailed work on that number. you know that there are a series of big ticket transactions that we had there, and actually basically they were unveiled in the month of November 2019. We had made progress, but in between, I think you had COVID pandemic. So while we did, as we recovered from COVID pandemic a little bit, and our transactions in the market have resumed, and we have raised quite a bit of money, including a very successful IPOs, starting with Mazgaon Docks, and then we had one on IRFC we just closed, and as we speak, you may see Railtel IPO in advertisements coming on because it's opening next week. So apart from that, there are several minimum public shareholding transactions which were done. So we have, taken the opportunities as offered in this, but cognizant, balancing with the fact that we owe it to our investors, particularly investors in CPSE stocks, that we will not actually do disinvestment in a manner which will adversely affect them, only from the point of view of price overhang that people had been complaining about, the repeated offerings at discounts. I think that sort of thing will not happen. We'll be more selective, we'll be more this, and so in tune with this. And I'm glad that the investors have actually started responding to the new change in our stance, because our change in stance is particularly reflected by Honorable Finance Minister in a statement to the budget, where she said that the strategic disinvestment and actually in the form of privatization would be the main leg of our disinvestment, and minority stake sale will only be a sort of a standby. So therefore, this is a very clear articulation of the change in the policy, and this policy actually unveils a whole lot of new dimension over the next 4 or 5 years of the kind of companies which will actually come to the market for strategic sale.
Mr. Pandey, I distinctly remember immediately after the budget at the Secretary Press Conference, you did allude to the fact that this is the new privatization process and it would be a rolling process, which means it will not stop at 1 year. It will be an ongoing process. So while we have a sense of the number for next financial year, what happens after that? How strong this process would be? Because this would be a multi-year process. What happens after FY22?
As I said, that this is an old pipeline and the new pipeline. And typically, if an M&A transaction takes about 6 to 9 months, depending upon the complexity, you would always have a rolling plan where the new pipeline keeps getting added. The latest one was added to this pipeline is RINL, which is a Vizag steel plant. And so therefore, I mean, these new things will start getting added. But I must say that, you need two hands to clap. And obviously, if we have an offering, we also expect that the private sector interest is also coming forward to pick up those offerings. So as private sector sentiment also revives through the slew of measures which the government has taken in terms of economy and the stimulus, the capex and so on, we would expect them also to come and make disinvestment offerings as one of the important aspect of their capital formation strategy, which includes, basically the brownfield assets, which could be then taken to new heights. So what we want is that this policy is not actually to just about raise numbers for the budget. This policy is for growth of India, growth of employment, growth of enterprises. And obviously, asset recycling, asset monetization, brownfield thing, non-core, this is only to instill the sense of productivity. I would say this is a structural reforms and the very important structural reforms going forward.
I can share with you, sir, the level of excitement among investors after the disinvestment number was shared and the kind of good work your department has done is absolutely incredible. We spoke last in the month of October, November, and post that conversation, PSU stocks in a sense have massively got re-rated. Earlier in the year, or earlier in somewhere in 2020, Mr. Pandey, you did allude to the fact that PSU stocks in India are not getting their fair value. Markets are not recognizing the true potential of some of the great PSUs India has. Uh, are you very conscious of that fact? Are you consciously working towards a fact or process where PSUs should get better recognition from investors and markets?
Indeed so, because this this is basically three pillars. The first one is to look at the PSUs themselves and look at the way they actually perform, because performance is also very important. And so therefore, I think what you're doing is that in some of those MOU criteria, we are including from next year onwards a number of the marking system, which is quite attuned to the market. How the market listed companies, how is their market cap increasing? How is the engagement of the management with the market? What are we doing with the return on capital employed and return on equity? What is the asset turnover ratio, whether your assets should actually be producing sales and they should not be producing, so the capex has to be really productive. We have also said that compliance to having an asset monetization plan is a must. If you don't have a good plan, if you don't execute, you get a minus. So these are the kind of incentive system we are working for. The system. The second one we said is consistent dividend policy. And therefore we have even gone for dividend even more than once in a year. Typically that was conventionally done, and a high dividend company could even actually probably be even announcing dividend with every quarter, interim dividend every quarter as well. So there is clearly government is a shareholder, but not the only shareholder. In a listed company, we have responsibility. There are minority shareholders on the other side. And we also don't want decision making at the government level to be wrecking the prospects of those investors. So that's the point. The second part of the strategy is that we have stopped ETF, because ETF were claimed to be causing a lot of consternation, because there were repeated offerings at discounted prices, and they were not really very much amenable to a good investor, from the point of view of investors. And therefore, it will be, based on the liquidity, where the liquidity is required in the stock, that we would be coming out with an offer at the right price, at the right time, selectively. And therefore, I think we are very conscious of that, and we have given that comfort to the market.
Mr. Pandey, I surely do not want to get this one wrong, but correct me if my interpretation is wrong. What you're committing to the fact that the disinvestment number, what has been shared by the Honorable Finance Minister, that is going to be a clean disinvestment number where one government company will not be merged with another government company so that the targets are met. This is going to be clean strategic stake sale.
Well, I mean, I would not say that we can say in that manner, because in some of the cases the consolidation may be necessary. If you look at our policy, when a certain consolidation will be necessary, that will be done. But that is not really, as I said, that we are not approaching only from the point of view of fiscal number, but as a point of structural reform. Then obviously we are very conscious of the fact that if one CPSC is sold, government stake in one CPSC is sold to the another, just to get the fiscal number, obviously that may not be treated as a reform, because ultimately reform will come when the control is passed on, and the control will be passed on only if we do strategic disinvestment, strategic sale. Because even if we actually do minority stake sale, of course we share the company and its prospects with the investors, but certainly the government doesn't cede the control there. The control remains with this. So therefore, the ultimate objective, if government says that it's not business of the government to be in business, that will be only fructify if we not only remain confined to only the listing and giving offerings on the minority stake sale side, but actually pass on the control to the private players. So that's what the ultimate intention, and that policy has been clearly stated and outlined by Honorable Finance Minister.
Mr. Pandey, when we met last, that was about 2 months ago, and that time you indicated that BPCL divestment is 6 months ago. So simple maths, 6 minus 2, that means BPCL divestment should happen in next 4 months?
Well, I think, yes, I think we are targeting the first quarter.
At what level is the engagement in BPCL from interested parties?
Well, the engagement is intense now. There's a due diligence stage.
And the reserve price and other strategic pricing has been identified.
Well, as I clarified, as per our process, our process is basically on, value maximization. And obviously, we have to take all precautions to see that the value is maximized. So what are the processes really clearly laid out? One is that, competitive bidding. So it's all based on competitive bidding. Entry barriers we are keeping low, but reasonable. We are normally not having technical criteria in the sense that, the strategic buyers would be only belonging to a particular industry. We know that diversification is taking place. So there are people who are moving on to different industries, and there are a lot of other players who are coming in the market. So therefore, we are having least of the criteria, only to the extent of net worth criteria we normally have to ensure that actually the transactions will actually be consummated. So that is one part of it. The second part is, as I said, criteria which are reasonable. Second is competitive bidding. Third is a reserve price value fixation that's always done after the financial bids have been logged in. And we are very conscious of the fact that we don't want any system leak or anywhere on any of the reserve price or any particular person to take any undue advantage of that. So therefore, we have a process where reserve price will be fixed based on professional advisors that we hire, but it will be fixed only at the appropriate time after the financial bids are locked in.
The Honorable Finance Minister also referred to 2 banks which would be privatized where majority stake would be sold. How soon do you think you will be able to share the names?
I think it should be soon, because Finance Minister really mentioned about the intent, which was the major policy on privatization, which I think many analysts and economists and the market players have been waiting for a very long time now. So I think the holding company or the privatization, that constant debate has been put to rest. And then the action, the 2 public sector banks and 1 insurance company. And you read it also with our policy, a new PSC policy for Atmanirbhar Bharat, in which we say that the 4th sector, strategic sector, which is banking, insurance, and financial services, we will only be retaining the bare minimum. So this is a broad policy, and of course, identification will be done in due course, and process will be carried forward. But the way Finance Minister has mentioned in his speech, the action is already intended. So it's not merely a change of legislation, but also the action that will follow.
Mr. Pandey, let me try my luck. I'm a journalist after all. My job is to also perhaps try and seek as much information I can for our viewers and the attendees here. The 2 banks which the Finance Minister referred to, are they listed or they are not listed?
No, I would say that we will cross the bridge when it comes, and we will certainly share that information with the media at the appropriate time.
If I insist, how would you respond?
I would insist, you would not insist.
Mr. Pandey, before the year ends, the big one is, of course, VSNL, now Tata Communication. Government, your department has already indicated that government wants to sell the stake there. Where is that process, and are you confident that the remaining stake in VSNL or Tata Communication will go through?
Yes, indeed.
Okay. Where is the LIC IPO, sir?
LIC IPO is, as I've explained also earlier in different media interaction that I have, that the critical thing is to prepare for it in different aspects, and simultaneous work has been going on that. So FM has already introduced a Finance Act, and LIC legislative amendments which we required in the LIC Act are a part of it, basically aimed at the IPO. Because there are structuring issues, there are also issues regarding the constitution of board to make it, amenable to listing. The second leg is, of course, the preparing it for in terms of various activities for preparing its prospectus. And I think that work is going on. We have got professional advisors which are in place, which are advising on a day-to-day basis. The plan has been drawn up. The third critical item in the LIC IPO has been the discovery of the embedded value, which LIC has not been earlier doing it because it was actually exempt from doing so. It's an important requirement from IRDAI for before listing, you got to have an embedded value. And that work has actually started with LIC appointing their advisors and also changing the software. The work is on. And DIPAM itself, we have appointed the reporting actuary, independent reporting actuary also to report on that. So this is the process which will is necessary work, which is going on. And as regards when we will consummate the IPO, I think FM has already indicated that it will be done in FY 21-22.
Are you looking at selling a significant stake in LIC? The reason I'm asking you this is, let's take an example of NTPC or Coal India, where the government, when these companies, they went public, they did not sell a large stake, but subsequently via the ETF route, the government kept on reducing their stake, which in a sense had an impact on the market price. Would you be having a different approach for LIC IPO?
We will have a different approach in IPO. As I said, that in general, we have not been able to go. The ETF was more like an index thing. The problem was that if you put different people in the different basket, it was intended to actually diversify. But point is that any instrument which is used excessively sometimes does not yield results. So, I mean, in case of LIC IPO, I think it's an early to say what will be the size of the IPO that will come. But certainly, it will be a large IPO. And I think in the legislation itself, we have provided that up to 10% can be reserved for the policyholders.
Air India, Mr. Pandey, may not be easy. I'm not doubting the intent here, but given the fundamentals A of the sector and B, how the landscape essentially has changed for the global airline sector.
No, certainly, I think the airline is on the recovery phase, and we had a very deep impact on that. And now I think from here onwards, we can only see recovery in the aviation sector, which is happening already. So therefore, it's a going forward, and airlines will go for a long time. So it's not a really immediate 4 to 5, 6 months issue. In case of Air India, we had enough opportunities earlier for the Air India. We had a turnaround plan which didn't succeed. And ultimately, it had to be divested. It also fits into our new PSC policy, which itself wants government's roles. And certainly, airline, shipping, and all these things is not also very much in our strategic side.
Would you say that strategically, you would also be looking at selling or reducing your stake into a sector like metals or commodities?
Well, metals are generally not in the strategic sector, the way the policy is.
My colleague Ruchi, who tracks the ministry very closely, she's just pinged me with a question, and she perhaps wants to ask and wants to know from you that you have opened up strategic sectors where the government will have maximum ownership in 4 sectors, something which you already mentioned. Which means if I look at the size of the work which will now start at at DIPAM, is going to be huge.
Certainly, I think it's a whole new world actually, which will open up and will need to build up capacities.
Mr. Pandey, there is definitely a change both in terms of ideology, approach, and also the way you're conscious of the market dynamics. Why there has been such a big 180-degree turn at the DIPAM?
No, I don't think it is an evolution if you really look at it, because the strategic disinvestment policy was opened in 2016. And in fact, several transactions have been carried out. In fact, Air India and others, they have been, it was an EOI was issued even earlier. Of course, it didn't succeed at that time. So I would not say it's a 180-degree turn. I would say it is also a learning process and an evolution. And I think the also COVID crisis and others have told us that, if we really catapult, Indian economy into high growth path, we need to have structural reforms, which will go into the medium term. So it's not a question of 1 year fiscal and 1 year number that we are looking at. This whole policy is to be conceived in terms of how our enterprises, at least some of the public sector enterprises, together with whatever the private sector enterprises, can actually grow to a level where we really become Atmanirbhar. So what is Atmanirbhar Bharat? To produce, at the low cost, high productivity, high, reliability, and with good quality for us and the rest of the world. And in order to do that within the boundaries of India, it's not really, it's ownership agnostic.
Couple of last questions, Mr. Pandey, and something which in a sense is a political challenge. We've seen that every time when government has tried to divest their stake or ownership, they have to fight with labor unions. Labor unions put their arms up in air. They fear job losses. For private sector, this kind of a proposition sometimes gets nightmarish. How will you ensure that this process is smooth?
I think we are also, engaging with the labor union, and we have to look at the present context, economic context. I think what we really want, jobs and productive jobs. And this is the way only India can grow. So I think the jobs have to be, that means, and you have to, in order to create jobs, you have to see, you have to have organizations which can handle that very fast technological change which is happening. Manufacturing is undergoing a sea change. Services sector itself is undergoing a sea change. We have different sectors being, the sectoral shifts are taking place. Now, what we really require in, amazing level of smartness of the managements and workers, in order to also not only, go for the newer avenues very quickly, shift your focus, adapt new technology, but also learn new skills. Now, what we really see is that we will require to equip ourselves, both the management and the labor, with a sort of nimbleness. Ultimately, it's any good enterprise, any successful enterprise is a joint thing with it. It's not between we and they kind of a situation. If we have to secure jobs, both for the management and the labor, see, if the company falls, if the management jobs go, so it's not that, it is nobody's interest. If they, it doesn't help the economy. It doesn't help. You end up in importing. If you can produce the same quality and with the cost and all that, and technologically you keep on advancing, and in fact you, rather than you meet your demands and you export to the world. That's what India is. India is young, and it needs a lot of jobs. So therefore, we have to really see, how does it matter? It's a public sector. The point is that we recognize that in the public sector, we really do have this issue because the government is bogged down by huge number of other issues as well. So the kind of focus you require for a company may not be available actually the way it is available in the private domain.
Two more questions, Mr. Pandey. The fact that the disinvestment targets for this year will not be met, can it be blamed only on COVID?
Of course. If you really look at it, the way, I really encourage you to do also track PSCs, PSU, this thing. Please don't look at Sensex if you are talking of CPSCs. Please track the other index, which is BSC CPSC index. See how it tracks, how it fell. That's only the one part of it. And two of our major transactions which were on board, the oil and the aviation sector, were precisely the sectors which were initially hit by COVID. And mind you, we have been working all through in COVID times, And in July, we had a bond ETF. Of course, you don't give us, grant us any benefit, because you always media is obsessed with a single number of how much you have produced the disinvestment receipts. So you don't see the reform, what is taking place. The Bharat bond ETF is a unique product in the world.
It is, and we are very delighted about the kind of product of
we had another tranche which we had in July, a very successful thing right in the midst of the very heavy COVID.
I must say, sir, the kind of numbers and the kind of transparency and the kind of indications what you've given her, not me, everybody is certainly very excited, and global investors are doing cartwheels that this is the government privatization process will be the single biggest reform which will change the course of India's growth. I used to always say this, that before the budget, India came back from survival to revival, and now from revival, we will actually go to flourish. One last question, sir.
But I must say that we need two hands to clap. So if we are offering, there has to be some other equally important. So I think when we express EOI, we expect a number of bidders to line up. So that will encourage us to give more offerings.
A lot of senior management people on this team, so that is going to be perhaps an indication from you to them that look, the government is looking at keen engagement and for strategic sale in key sectors. One last question, sir. What is the idea of national champion which the finance minister alluded to? How does this fit in your entire strategic sector narrative?
Pardon?
The whole idea of national champion which the honorable finance minister referred to in the budget. How does this fit in with you, with your department?
No, our department is also, the point is that as we say that we have some of the strategic sectors in place, and we have sort of set the bare minimum. We are looking at, these should be, whatever bare minimum is, that they should be really the big ones. They should grow, they should be, benchmarked to the best in the world, and they should be made free. We have started looking at dividend. Media is not tracking dividend because in my website, I put the dividend receipts as well. So, the dividend goes to the investors. To me, as well as to several, to the government, as well as to several minority investors who have invested. So these are all important. They're all interconnected. And so therefore, what we want is that, the organization which we will part with should also reach heights. The organization which we should retain, they should also reach heights. And together it will be Atmanirbhar India.
Well, we all should consciously work towards that. The tagline with ET now is always rise with India. And let me assure you, sir, that if we were in a normal setting, not a digital setting, this entire conversation of ours would have received a table thumping applause, because you've been candid, you've been honest, you've been frank, and you've shared nothing short of a very visionary intent of where the department wants to take the entire disinvestment process. Let me assure you that thousands of investors and attendees who are watching this, they would be excited after the kind of firm indications which you've shared with us. Thank you very much, sir. And I certainly hope to connect and certainly hope to see much more of you going forward.
Thank you very much. It's been a pleasure. Thank
you. Fantastic. Thank you so much, Shri Pandey and Nikunj, for that. Those were some really great insights that Shri Pandey shared with us, totally kicking off the day on a high note. Now, moving on, the real estate sector in India has had a bit of a seesaw ride last year. The pandemic led to a drastic reduction in the rental of commercial workspaces, but it also saw an increased interest in home buying. Now, as the lockdown eases, what is on the horizon for this sector? Here's a look at the panelists who are joining us for the session, Real Estate Sector New Horizons on the Anvil. All right, please welcome Mr. Vivek Anand, Group CFO of DLF, Mr. Chanakya Chakravarti, Managing Director, Cambridge, and Mr. Anuj Puri, Chairman, Anarok Property Consultants, and they will be in conversation with Chanchal Khandelwal, Fund Manager and Senior Analyst, Equity Investments with Aditya Birla Sun Life AMC. Over to you, Chanchal.
Hi, good evening. Thanks, Sumit. Welcome, gentlemen. Welcome aboard as we are in the journey of the voyage to 2021. The entire discussion is about the next decade in real estate. If I take a step behind and look at the past decade, 2000 to 2010 decade was all about residential real estate. The 2010 to 20 decade was all about commercial real estate. We, in fact, sometime in 2013-14 peaked out in residential, and the prices has been stagnant for last 7-8 years. In commercial, we have seen a decent built up, and we have seen the rental prices going up almost 30-40% in last 7-8 years. What will the next decade be? That is what we are trying to decipher here. But before we start, Chanakya, let me take a step back and see what went right in the commercial real estate. What did private equity saw coming, and what was the thing which played out in the last 10 years?
So, thank you, Chanchal. Can you hear me? I'm sorry,
yeah.
I'm experiencing some trouble. Could you just repeat your question again? I lost you there a little bit.
Chanakya, I was talking about the commercial real estate. When private equity investors invested in 2010 to 12, what did they saw coming and what played out in the last decade in the commercial real estate?
So I think, Chanchal, my immediate reaction would be the last decade has been quite transformational for commercial real estate. Particularly the office market. When I say commercial real estate, I also include retail. So as far as the office market is concerned, I think we've basically seen it moving from a non-institutional asset class to an institutional one, and that culminated with the listing of the Embassy REIT in April 19. I think prior to that, from the global financial crisis in 2009 to 2019, the whole decade, we saw quite a remarkable change in the caliber and the quality of the office market demand, primarily because India, basically made the journey from being a low-cost business process outsourcing location to a value-driven core global location for core competencies for major financial services companies and across sectors. Why just financial services companies? And I think what that did was it showcased Indian talent front and center, and that allowed global corporations to appreciate the depth and the quality of Indian talent. And basically one thing led to the other, and a lot more core functions started getting offshored. I know that's a little bit of a controversial word, but for the lack of a better one, offshore to India. And they are now called global competency centers or global in-house centers. There are various nomenclatures. So I think that has been the journey. And what that has done is that global corporations no longer look at India as just a cost arbitrage from a real estate infrastructure point of view, but actually look at it as a significant accretive or additive to their entire global corporate performance because of the quality of the talent they're able to leverage and across a number of competencies. So I think that has definitely benefited commercial office real estate. Retail, I think, is still early days. I mean, compared to even emerging markets like China or Brazil, India is a very small retail market. And I dare say that the pandemic has changed the rules quite dramatically globally for retail shopping centers. And it remains to be seen what impact that has in India. I mean, I'd like to think that it's still a very nascent market, so there will be opportunities. We are under-mauled, if I can use that expression. So there seems to be logic for expansion. But I think, based on what we see in the Western Hemisphere, buying habits have changed quite dramatically. There is a massive pivot to online, and India is no different. I think India is on the verge of a cusp of a digital super cycle, and I think retail shopping centers will have to face that reality. Maybe not to the extent that we're seeing in the West, but there's a saying: when you look behind in your rearview mirror, things are much closer than they seem.
So interesting insight both on commercial and retail. I'll come back and debate on retail, but before that, let me pick up Vivek's view. Vivek, you must be meeting a lot of tenants. You have a big office market. It works from home. Are you seeing some consolidation happening? Are people giving up some office space and renegotiating rentals? What is the scenario there?
For having me on the panel. Am I audible? There is some background noise.
Yeah, Vivek, you're audible. Yeah.
Okay, it's much better now. So I was just saying thank you for having me on the panel, Chanchal.
And Anuj has joined. Hi, Anuj. Happy to have you here.
Yeah, Chanchal, thank you.
Hi, Anuj. And good evening. So I think on the office side, I think we continue to remain having a positive outlook on our office business. Let me start by saying that. Right, you are right that we had a temporary blip in the occupancy, right? So actually, if I really look at our occupancy levels currently, it is currently at 91% from a pre-COVID of 95%, right? So it has actually dropped. So vacancy has increased by 4%, right? But if you really look at our collections, we are having in the last 9 months, that's upward of 99%, right? So good news on the collections. So let me talk a bit about the vacancy rates going up. And I think that's largely to do with the small tenants who had some financial difficulty during this COVID time. And they are especially in the sectors of co-working, hospitality, and e-commerce who are largely providing services to hospitality business. But if you really look at a large chunk of our tenants, right, majority of our tenants, they are having strong balance sheet. They are amongst the 500 Fortune companies, and with, as I said, with relatively strong balance sheet. I think there is very little discussion we are having in terms of renegotiating the rentals or resetting the rental base, right? While with some of the tenants, which I'll say are smaller, who are still going through this financial difficulty, we are having a reset, but in my view, that's not going to be material, right? Having said that, in the last 6 months, if you really look at our assets under construction, we've got a very, very good response on the leasing side. So we have close to 3.5 million of assets under construction in Chennai and Gurgaon market, and almost of that, 38% has been pre-leased. So that's very, very encouraging sign. We are seeing that in Chennai, where Stanchart has signed a 8 lakh square feet office lease with us, right? Very recently, we signed a 2 lakh square feet lease in Gurgaon. So I think those trends are very encouraging. At the same time, we had a new office building called Cyber Park, which is now fully operational. A lot of tenants are operational there, and a large part of the tenants are close to completing the fit outs. So I think that's also very, very encouraging sign. So I think to sum up, I'll say this is a temporary blip, and we expect normalcy to restore in 3 to 4 quarters from now.
Sure. Thanks, Vivek. So Vivek, you are saying that this is a temporary blip. Anuj, to pick up from you here, you think, the office market, the fact of the matter is that the absorption has gone down from the peak absorption of 54 to 27 this year. You think that the office market or rentals will be stagnant for 2-3 years before we see any pickup in the demand for commercial? And also, but bringing up retail real estate, given that work out of home is the new norm, and weekends and weekdays are similar for almost all of us. Do you think retail real estate will pick up in India? The supply is less. People want to go to a good quality mall. What's your view on both this asset class?
Yeah, so very interesting. I was listening to what Vivek said, and Vivek bang on. Most of the listed guys, if you look at it and you pick up the REIT guys' balance sheet, are very similar to what you have said. The vacancy rate is in the low 90s. The collections, which has been fantastic, Vivek, is 99%. The occupiers who have left are in the retail, hospitality, food court, that sort of space. And the pre-leasing has been pretty strong. And Chanchal, to come to your question on that is, we are seeing two aspects of it. One, grade A quality space is doing better than grade B, grade C. You will continue to see is that most of the listed guys, because they deliver A quality grade space, they are the ones who are going to pick up momentum, pick up the speed on the leasing. So overall market will shrink. You're exactly right. It may be at 50, 55, 60% of 2019 and 2020. And our thought is it may increase a little bit, but still it will not get to 2019 levels. But yet you will see is many of the listed developers leasing activity very vibrant because they're delivering A grade office space and the occupiers are exiting B and C grade office spaces. And that's where they will continue to benefit on the office. On the retail, I agree with Chan. What he said is, I'm absolutely sure on this, Chanchal, and I don't know whether the viewers are from America, Europe, or the rest of the Asia Pac. They are going to have a negative view on retail because internationally in more mature markets, it has had a big impact. I don't think India will have that kind of impact. Chan is right. There will be an impact because of the e-commerce, because we are under-penetrated on organized retail real estate, unlike the more mature Western economies, which have a lot of the mall spaces, and hence, from their perspective, they are going to see, or they are seeing the impact we may not see. Second, Chanchal, is that, it is a social space for us. I mean, we don't have museums and parks and central parks where we can actually go in. For us, entertainment over the weekend is, going and meeting up with friends and family in a mall. So unlike some of the more mature markets where there are other things to do on a weekend where you are able to culminate and that becomes your social fabric, in India, mall is that space. So I don't think it is going to get replaced the way that in more mature markets have been done. Yet I agree with what Chan is saying is that the profile of the tenants, Chanchal, the profile of the retailers will have to go through a change. Would I go back to the mall to buy a white shirt that I'm wearing? Perhaps not. I'm very happy to do it online. Yeah, but it'll have to be different category of retailers, more experiential, more sort of smell, touch, feel, sound, that sort of a thing that you will have to do. A lot of F&B, a lot of entertainment. That is the experiential retail that you will have to bring rather than what was being sold, because that all may today be sold very conveniently online and the consumer is happy to buy that online. But these will remain very vibrant social places where you will see a lot of the footfalls continue to happen. By the way, Chanchal, if I can just add very quickly, and Vivek will know this quite well, the footfalls in the malls, in the good malls, are about 75% of the pre-COVID level, yet the consumption is 87%. Of the pre-COVID level. So, you're really coming back nearly to normal consumption levels.
Thanks, Anuj. That was useful. So grade A office space will see the occupancy not coming down, and probably quality malls is here to stay, and probably they will grow big. Good consolidation may happen at the non-quality space. Chanakya, you spoke about REIT while you were talking about it. How has India done in terms of the REIT regulations? We have seen 2 REIT listing. The third is on the pipeline. Has India matured enough, and you will see a lot of REITs in Indian market?
Yeah, so look, my take on the situation is, I'll preface my response by saying you mustn't forget that the Indian real estate market, for all practical purposes, from an institutional investor point of view, is only 15 years old. or 16 years old, to be precise. 2005 was when the market was opened up for foreign investors. So everything that I say must be seen in that context. And I would say that the market has done a phenomenal job. And I think the regulators have done an absolutely terrific job of being able to, first of all, benchmark regulation to global markets like Australia and the UK and the US. And so in that sense, from get-go, they have adopted gold standard with the retail investor in mind and their safety and security, promoting a complete transparency to make sure that dividend yields income is goes back to them to the extent of 90%, and so on and so forth. And I think the proof of the pudding is in the fact that, don't take my word for it, look at the performance of the 3 REITs thus far, including the Brookfield one. If you take the Embassy REIT in April 19, there was hardly any mutual fund participation, domestic mutual fund participation. It was primarily book built by foreign institutional investors. If you look at Mindspace, it increased somewhat more. If you look at the follow-on issuance by Embassy REIT in December, there was some more participation. And now if you look at the Brookfield REIT, it's primarily domestic. And I think that kind of tells you that domestic investors are now getting more familiar with the concept, and they appreciate the product in a low yield environment, where these REITs have a potential to grow both in terms of scale of volume as well as ability to scale up their NOIs because of opportunities either by way of cheaper refinancing or by way of under renting and so on and so forth. And so I think investors are also becoming more discerning. Retail investors and domestic institutional investors are becoming less suspecting, I would say. And that's very good news because we need a very strong, deep domestic investor profile rather than relying on foreigners coming in to buy units alone.
Sure.
I think the other factor that I would say is very encouraging from a regulatory standpoint is now the new proposal in the new finance bill to allow dividend income to be tax exempt. Basically, they're throwing out the red carpet. I don't think the government can do much more. I mean, they've virtually acceded to all requests that have come from industry. And finally, I think the allowing FPIs to come in and invest in debt issued by REITs is another accretive instrument for REITs to basically increase yields for investors. So I think for a variety of reasons, I'm quite enthused as a foreign investor, because if I bring in capital in the country, the first thing I look for is what are my modes of exit? Do I have to bring in another foreigner to buy what I'm building out here? And clearly, I think the ability to exit to domestics is very, very encouraging.
So, thanks, Chanakya. In fact, that would be music to the ears of Vivek, the fourth REIT in the pipeline, probably. So next decade we'll see a lot of REIT happening, and the Indian market will probably mature in the REIT space. But coming to residential real estate, Anuj, I want to bring you in because you do a lot of work here. Has the pandemic taught people the importance of owning a property, and people want to own bigger home? Something triggers a new cycle. Is this a start of a new residential real estate cycle?
So, Chanchan, very, very good question. I don't have an answer to that, whether it is the start of a cycle. But I tell you, Chanchan, when this lockdown happened, end of March, we guys were scared. April, May were scary months. That, our thought was, who's ever going to buy resi in this market? Your job security wasn't there. Commissions, bonuses, were just not there, salary increments weren't there, and spending that kind of money as an outlay was difficult to witness. And then I remember speaking with someone very senior in the US, and he sent me Wall Street Journal's article. It was sort of August, September time, and it said is US resi sales in those 5 months had touched a 14-year high. And at that time, Chanchal, our Bangalore office opened, and it just did exceptionally well, as if there was no COVID that had happened. And we thought maybe this is a pent-up demand. And then slowly the rest of the offices opened. Second office was NCR. DLF did a fantastic job. We were partnering them in Lucknow, and it was like a 24-hour sellout that happened in there. And we thought it is perhaps a pent-up demand. And our thought was, Chanchal, that this will start to wane down by October, November, December. And by December, definitely, this is going to fall off the cliff. January has been equally strong. And, because we sell about 20,000 apartments a year. So, Chanchal, we have visibility of the next 3 to 4 months, because the footfalls by now should have gone down. If it was not going to be something that was sustainable, the footfalls continue to remain as vibrant as ever. So, it does appear that it is well going into April, May as a very strong cycle. So to answer your question, it looks like that it is beginning of a sort of 5, 6, 7 year resi cycle. I hope this time, Chanchal, we have the right players who are rallying. And why I say that is, in the past, in 2008, when the global financial crisis happened, 2009 made the market came back. It was like a wave that came back. All the fishes that were on the side, which were the developers, they took all the fishes back and everybody swam. This time, I hope that the consolidation phase comes in, that it does not pick up, the fishes who had spoiled the market, and they leave it on the shore, and it's only the more corporate governed, financially disciplined, customer focused, delivery focused fishes that actually go in there. And to my mind, Chanchal, that is what is going to happen. It will be a very selective cycle that will come in. And 2 data points I'll give you very quickly. One, we did an analysis and we discovered that from 2012, and I'm just reading it out, 2012 to 2020, 53% of the developers had gone out of business in the top 14 cities. We put down all the developers, 53% of the developers had exited the market. The second data point I give you is that the share of the listed and leading developers, so listed and non-listed, but leading developers in the various micro markets of these 14 cities, the overall sales increased from 17% market share that these guys had in financial year 2017 to our expectation is that March 2021, it will be 44%. So half of the market is now getting consolidated with very few people, and hence in a market again where you will see a reduced take up of inventory in the financial year 2020-2021, many listed guys will do exceptionally well. So just your viewers will hear a contrasting statement that the market has shrunk, yet some of the guys have done much better because it is the wave only taking selective fishes back into the sea.
So just to sum it up, December quarter was the highest ever quarterly volume we saw in last 10, 12 years. And we've seen a consolidation happening in this space. Vivek, to get you in, consolidation has happened. We have seen reform like RERA playing out. 53% of the developers have gone out. What will be the success of the developers in the new era? How do you think it's the game is up to you to play? If you will be able to scale from 2-3 million square foot to 10 million square foot, what are the building blocks for DLF which you will play out in the next 3 to 4 years?
Okay, thanks, Chanchal. A lot of questions in one. Let me start. So I think you are right. I think DLF is fully geared up to catch the next cycle of growth, and I'll explain you how. I think first of all, we've announced our product pipeline, a very diversified product pipeline of 35 million square feet, which we are going to launch in the next 4 to 5 years. In fact, this time we've also shared with the analysts our launch plan, right? So that's one. And when I talk about the launches, we are actually really launching our product in established locations. I think that's something I think that's something which is a very strong point we have. And we are actually diversifying our product portfolio in line with the consumer demand, right? So we've always been present in premium and luxury. Now we've got into value homes, and we've also added a portfolio on the commercial side. That's one. Having said that, we are also really making sure that we stay with the core, right? When I talk about the core in terms of our product and also in terms of the geographies, which are our core geographies, NCR. At the same time, we are also entering into the market where we already entered at some point in time, right? So we are not trying to really get into a completely new market, but certainly we are looking out for something in West, in South, which we had done at some point in time, right? So I think one very clearly, as I talked about, our launch plan, which is very diversified in terms of product portfolio, in terms of geographies, and in established locations. So that's something which we are really confident about. Secondly, our business model. I think we are also really looking at the way the demand is moving, the consumer preferences are moving, right? And we have also tweaked our business model in line with that. So a large part of our development, we've kept it in the cycle of 18 to 24 months to really make sure that we have a good cash conversion rate. That's something very, very important. And also all our new product offerings are going to be either margin accretive or margin protective. We are not really going to dilute our margin. So I think that's something which we've also kept at the back of our mind. And third, earlier, unlike in the past where we were building and selling, now I don't have to really complete the construction. We can start selling it after we launch. So I think that's the changes in our business model, what we've made. And we've already started to see a very, very positive impact of that. And you've seen that in our results in the last 2 quarters. So that's the second thing I would say. Third thing, I think we are really investing in organization capabilities, right? While you may have a best of plan, you may have consumer demand, but unless you know how to execute it on the ground, it's of no use. So therefore, we are investing in organization capabilities. I think we have now half of our leadership team is new, which has come from different industries. They've come from different backgrounds, right? We've had a rehire across
in fact, it was not heard of when you came from FMCG background, a lever and Lexer background to a DLF. So the pipeline and institutionalizing the process is happening in the residential market. Good to see that.
No, you are absolutely right. Right. For me, I was always in the business of selling soaps, right? Right. A 10 rupee soap. Now I'm selling an apartment which starts from 2 crores. So that's the big shift I have seen, right? And so is the other leadership team who we have now on board. We have people from Coke, right? We have people from IT industry, and we've also hired people from real estate industry, right? Different age groups. So I think there is a lot of diversity in our leadership team, and the same thing has actually flown down the organization. We've strengthened our IT capabilities. We are upgrading our ERP. We are investing in our processes. We are redoing all our processes. We are strengthening our procurement function. So I think those are the other capabilities. And in fact, we are bringing in a lot of technology into the construction, right? So there is a traditional way of really constructing a building, and we are really looking at using technology in the way we do things, which is more cost effective and also shortens the period of construction, right? I think this organization capability, as I talked about, all these three really gives us that confidence that we are really getting ready for the next cycle of growth.
Interesting, diversified, launching 35 million square foot, you're preparing, gearing up for the new cycle. Chanakya, just your brains. Why private equity investment always comes in commercial? Why have you guys not invested in residential? Any thoughts on those? And second is, do you think is there money to be made in affordable housing?
Great question, Chanchal. I was wondering why you hadn't asked that earlier. I think the simple answer is, there's a lack of alignment of interest. I mean, I'm talking generally. I'm not making any specific comments. Equity is not respected. Private equity is not respected in its truest form in the for sale resi market. So the lack of alignment, when I say, I refer to the fact the lack of a promoter equity in residential projects. DLF, like Vivek explained just now, is a rare commodity in this market where they're actually building and then selling. Thus far, if you look at the last decade, why has there been a lull in sales? There's a very simple reason. It's a trust deficit. It's not lack of demand. It's not lack of demand. So what was happening was developers were being fueled by this so-called steroid, which was in the form of capital from various NBFCs, which were at unsustainable interest rates, and as a result, the whole capital stack was either private equity investor equity, NBFC capital, which was preferred equity or preferred debt, and then there was customer advances. And as a result, in such a model, when the moment the demand nosedives, your business model falls flat, and the equity holder is left holding the can. That is what has happened. I mean, if you look at the foreign investor experience in private equity in for sale residential, it has been a disaster.
Sure.
And I think that is a lesson that needs to be taken away. One of the things that Anuj referred to, why is there consolidation happening? Why is 53% of the developer lot exited? Because they had no skin in the game. They were just having a free ride on the margins, and the moment the market didn't perform, they had no other way to go, and retail investors were left holding the can. And I think this is a fundamental change that RERA has brought about, forced change in terms of behavioral patterns, that these riffraff and have been exited the market. The residential market is going through a corporatization. You're going to see more and more corporate entities come in, because this is a real opportunity. The Indians are genuinely, there is a lack of housing, and I think the fact that Anuj referred to the successful launches in the mid-income residential market is a testimony to that. The final point I would make is, in a marketplace where today we are on a tax deducted adjusted basis, the interest rates are at about 2.5%. I mean, even if you didn't need a house, you should buy a house, because just the positive carry that you have the ability to have some capital appreciation, and even if it is just a positive carry, a spread of about 1% over your cost of debt on an adjusted basis, it still makes sense. But so demand has never been the issue. It has been the lack of ethical ecosystem, generally speaking, and I think that is now going to change. We are in the middle of the whole market. I'm not just talking about Resi, but generally the Indian real estate market is going through a massive formalization process. So I think the next 2 decades, I think you're going to see what has happened in other developed markets happening in India. And I completely agree with Anuj in that let's not get euphoric. Nothing is as bad as it seems, and nothing is as good as they make it out to be. So you have to have a sense of balance. So in that sense, I think I hope I have answered your question in a roundabout way.
No, thanks, Aditya. Thanks. Coming to Anuj, I mean, most of the viewers would be interested. So there's a supply consolidation which is happening. There's a demand which is there, and demand probably has strengthened now. So and the prices have not gone for last 5-6 years anything. Do you think next 4-5 years or next 10 years we'll see a huge uptick in the price because supply is limited, demand is there? It's a demand-supply mismatch, and property prices have not gone up. The input prices have been going up. What's your view on the real estate prices?
Yeah. So Chanchal, when Chan was speaking, a phrase came to my mind. I was in the US just before the pandemic, and I asked the same question, Chanchal, that you asked Chan, to one of the private equity guys, to say, sir, why are you not looking at investing into equities in residential? He turned his computer and there was a yellow post-it on it. It said India, India. I will never do it again.
Will it change in the next decade?
And I said, what happened? And exactly what Chan said he said, Anuj, simple. We are in the business of investing money. We make money, we lose money. That's okay. But I don't understand one thing on residential in India. My partner made money. Product made money. Why did I not make money? I think very difficult to answer that. And exactly, Chan, what you said this is exactly what it was. We think is that the market is now gone through that consolidation, and over the next few quarters, you will start to see players where there will be private equity who will start to invest coming in at a project level. To answer your question, Chanchal, on the pricing, look, if you look at most of the listed balance sheets, look at the margin percentage that they have on the residential business. It is very, very thin. For the effort versus the reward, for the risk versus the reward, it is just not commensurate. So, given where the input prices have gone, there will have to be two things that happen. Either, Chanchal, the land values have to start to come down dramatically for the developer to be able to make some margin percentage, or the sale price has to increase. My thought is it is going to be a combination of both. There will be some elasticity on the sale price. It's not that people's salaries have gone so high that they will be able to accommodate the full increase in the sale price. There will be an accommodation at the land valuation, and there will be an increase in the sale price. I have no doubt. By the way, Chanchal, in Bombay, we've started to see that already happen. In majority of the projects, we've started to see the price rise. I think it'll be reasonable. I hope it continues to remain reasonable in the affordability bracket, but we started to see 3 to 5% increase in the price already. So as the consolidation happens, supply gets consolidated, the unwarranted players who were discounting unnecessarily the product without the intent of being able to deliver that product, they're moving away from the market, and the serious players who are remaining are starting to now increase the price just to make sure that there is sufficient margin for the efforts that they're putting in.
Sure. Thanks, Anuj.
Can I make an additional point? To Anuj's point, I think the other reason why you're going to see a further consolidation and therefore price rise is, I don't know if you have seen the new consultative paper that RBI has come out on NBFCs.
Yeah.
The negative bias of the regulator on NBFCs lending to real estate is going to lead to further consolidation, and that is indirectly going to lead to inevitable price rise.
Sure. I think we are running short on time. This can go on for one more than 2 hours now, if I want to. But I would like to end with a tough questions to all three of you. Next decade, if you were to invest, will you do it in equity or will you do it in real estate? Anyone can go as you feel like. Who want to start? Anuj, you want to start?
So Chanchal, I think it is not or. I think it is and only. Clearly, on the real estate, particularly on the residential, Chanchal, it has now become more of a social security. So, if you're buying it for your end use, please go ahead and buy. If you're thinking you are going to be a speculator in this market, I would suggest don't come in. This is not a speculator's market to come in. But for the end use, please, whatever your savings, whatever your income is, 33% of it, put it towards buying your home where you want to live in.
So end use buy, and then remaining you can invest in equity. Chanakya, your view?
Yeah, I think I agree with that sentiment. Absolutely. I mean, and for me as a real estate investor, I would first invest in the asset class that I understand the most. And that's the way I look at it. I mean, don't try and be everything to everybody.
Sure, that's interesting. Vivek, your view?
See, very similar, but I'll say I'll allocate my capital in a balanced and in a diversified manner, as most of us do, between real estate and equity and other class of asset. Right. Let me start with real estate. I think Anuj talked about it. what is important is that if you really look at the pricing in the real estate in the last 5 years, it has been low single digit. And if I adjust for inflation, it is almost negative, right? And I think we are seeing pricing moving up, right? Not only in Mumbai, but in other markets as well, right? So we've just started to see that. And with commodities actually prices going up, I think that is a way to also, you will see that also getting reflected in the pricing. And we are seeing it after a very long time, and we are seeing a good demand traction as we speak. So therefore, putting money in real estate is going to be a very, very attractive proposition as I speak. At the same time, if you really look at equity markets, they are also having a dream run, right? Right, Sensex is at all-time high, 50,000 plus, right? If you look at Nifty Reality, right, that's also grown 100% since April, right? Even DLF share price has really moved up by 130%. And like
Janaki was just saying it's a $10 billion market cap today.
Yeah. So today it's a $10 billion market as we speak, right? So I'm not sure what happens after we finish the call, but before we started, that was the number, right? So I think both asset class to me are attractive from a real estate point.
Sure. Thanks. It was nice having all of you. So when the discussion next decade will be about both the asset class, you choose how much you want to invest, but be invested. Thank you, everyone.
Right.
Thank you.
Bye. Bye.
Fantastic. Thank you so much for that, Chanchal. And thank you, gentlemen, for those great insights into the real estate market. Really important points that you have shared here, which I'm sure our viewers have made a note of. All right, our next speaker is someone who has his work cut out for him. With the stock markets hitting all-time highs, the question on everyone's mind is, how high will the markets go in 2021? Well, here's a look at who's coming up next. Yeah, Mr. Bhatt. Well, as you saw, the next speaker, and like I'm hoping he'll answer my question, the one that I have on my mind. But to share the equity outlook and strategy for the way ahead, I'd like to invite Mahesh Patil, CIO Equity Investments at Aditya Birla Sun Life AMC. And Mahesh will be in conversation with ET Now's managing editor, Nikunj Dalmia. Over to Nikunj and Mahesh.
Do you want to ask your question first, Amit?
So I would love for you to ask it for me, sir.
Okay. Mahesh, fantastic to have you. Thank you for joining us. Mahesh, I actually have to open a dictionary these days rather than a finance book, because in last 1 year, we have perhaps seen all shades of market behavior: fear, financial Armageddon, panic, gut-wrenching fall, euphoric recovery, participation, FOMO. I don't know what else is left. In last 12 years, we've seen all shades of human behavior apply to the market. What do you think is the dominant flavor right now, and what will dominate this year?
Yeah, so I think you're right. I think, Nikunj, let me welcome all our viewers and our partners to this Voyage 2021. So last year was, I mean, it was a kind of a two halves, right? First half, okay, where we've seen bull and bear and bull markets in 1 year, right? And in many ways, I think it was extraordinary. And especially for fund managers like us, I mean, the kind of volatility what we saw, it was really a difficult period. But I think coming back, I think as we step into this decade and look forward, I think we are filled with a lot of optimism. I think really from pessimism, I think we have moved to the other extreme. And there are multiple factors to that. We are seeing, I think this is the beginning of a new era, beginning of a new cycle, new economic cycle for India and for the markets. And it's predicated on many things. I mean, we've seen after the crisis, just like any other crisis, all the central banks globally have come together and pumped in huge amount of liquidity. I mean, this time around, the total fiscal stimulus which was there was 3 times of what we saw during the global financial crisis. Almost $13 trillion of expansion of balance sheet by the top G4 nations, which is humongous. And low interest rates. Interest rates are almost zero in the US. And more importantly, the central bankers have ensured that they'll keep interest rates low for the next 3 to 5 years. So in this environment of abundant amount of liquidity, low interest rates, we've seen the reflation of the economy very sharply. Okay, it's almost a V-shaped recovery which has been there. And India also, while India was slightly behind, right, because we had extended period of lockdown, we also seeing that play out. And more importantly, I think from India perspective, see, we have been actually going through a slowdown even before the crisis, right? Our GDP growth, which was around 7 to 8% in the early part of the last decade, it came down, okay, and just before the COVID crisis, it was say around below 5%. So we went through multiple challenges earlier. We went through a major set of reforms. Modi 1.0 was a period where we saw large ticket reforms, the GST, the real estate regulatory bill, the IBC, the banking and financial services sector reform, and all that took its toll, okay, in terms of the economy and also in the corporate earnings growth. But as we step into this decade, we've seen this government actually, and especially after this budget, I think there is a big change in the overall narrative what we are seeing, right? Earlier, the focus was more on fiscal consolidation, trying to take care of certain issues which were disruptive. But now I think the focus is clearly on growth. And the budget also allowed for fiscal room to ensure that growth comes back. And we've got fiscally, the government will be accommodative at least for the next 2 to 3 years. And on back of the foundation what we have created, right, the reforms, I think we should embark on a new growth journey from here. And earlier it was mainly driven by consumption in the last 5 years. I think investments are also, we think, will pick up. Various efforts taken by the government to stimulate investments through the Make in India initiative, the production link incentive schemes. And we had a panel yesterday, right, about the manufacturing panel, and they talked about all these steps which are taken, which will actually be another pillar of growth, right? So we have consumption, okay, which is there, investments, which was kind of going slow and declining actually in the last 4 or 5 years. I think that can revive. And again, real estate sector, which is another large component, okay, part of the GDP, has also been in a down cycle for a long period of time. And the conditions are now favorable for the sector to also pick up with interest rates now below 7%, which is like what it was 13 years back, right? And affordability gap, which was large, has come down because property prices have remained stagnant. And overall, the consolidation, what we see in the real estate sector, is the confidence of buyers is now gone up, right, in the new projects under the RERA Act. So all these things are signaling to us that we would actually see GDP growth in the coming decade, okay, to be somewhere around 7% or even higher, 7 to 8%, which is our potential growth rate. And the last decade, actually, we were going slightly below that rate. And that optimism is what we are taking forward into this decade. and that is going to fire up the corporate earnings, profitability, and we have made a good start to this calendar year. I mean, corporate profit growth in this third quarter for Nifty earnings is already showing at around 25%. Mind you, this is at a period where we're seeing actually GDP contracting, right? So corporate India has responded fairly well during this crisis. They've been able to put themselves together, look at initiatives to cut costs, improve efficiency, and I think that will carry them through going forward into the coming years.
Mahesh, I'm going to ask a very basic question, which is that the comeback in the market has been nothing short of unreal. From throes of the pandemic, Nifty is up more than 100%. 7,500 is almost 15,000 now. The general fear amongst this attendee audience and a lot of audience whom we interact with and a lot of unit holders and investors is, has the train left the station? Is it too late now? Will this sustain? There is a fear of dar. How would you fundamentally justify that this is just the beginning and not the time to get worried, but time to participate?
Yeah, I mean, that's question which gets asked every time. I think every time the market hits a new high, people say, okay, we yahan se kahan jayenge, right? So let me put things in perspective over here. While there's no doubt that the market has rallied sharply from the bottom, and it's looking a bit expensive also on a P multiple basis. But see, market is at one end, but if you look at the economy, right, because finally market is linked to the earnings. So economy, actually, we are at the bottom, right? So if you look at the data points, corporate profit to GDP is at 1.8%, which is what it was in 2003. Right? At peak, it was 7%. So clearly, corporate profit to GDP is at all-time low. And from here on, the way if the recovery happens and what we are looking at, and the way corporate India is really working in terms of improving profitability and margins, and there is enough room for corporate profits to expand from here over the next 4 to 5 years, or even beyond that. And so I think in the coming years, I think you will see the corporate earnings growth actually surprising us positively. And if you look at it in the last decade or so, right? If you just see another slide which we have, in the last decade, corporate earnings growth was just 5%, right? At a time when nominal GDP growth would have been around 10% or so. And that time, Nifty gave a return of around 10%. What we see is now, as things normalize, okay, there'll be some catch up because it has been growing below the normal trend line of around 12-13%. Then if earnings growth in the next 5 years, next decade is going to be in the mid-teens, then returns even from here, right, can be in the low teens is what one would expect. Even if you factor the current high valuations, I think earnings growth will really compensate for that. So I think this is just the beginning of a big cycle what we are looking at. And if you look things in perspective, from here on, I think markets will continue to scale new heights is what we think. Obviously, there will be pullbacks, right, because the rally has been too sharp and too fast. But I think that's something that should not really miss the longer term picture, okay, what one is looking for, because I mean, equity investing is all about staying invested, right? So I would say definitely people haven't missed the bus. Even this is also a good time to invest, and that's what we are seeing. Even from here, investors would make decent returns. When I say decent returns, means say around 10 to 12%, which is not bad in the context of where interest rates are and where interest rates are going to be in the medium to long term.
If I may ask a fellow Mumbaikar in Mumbai terminology, let's say if the train has to go from Churchgate to Kandivali, where do you think the equity market train has reached?
Okay, I would say the train is somewhere around Lower Parel, okay, where our office is, right? So we are probably somewhere around say whatever 20% of that journey, right? So I think it's still a long way, right?
20% of the journey, which means this decade belongs to India. What you are saying that if after 100% rise, if markets have recovered, if after 100% rise, you only travel 20% of the earnings potential and the economic potential, that means next 4-5 years, we are in for a good return.
So I'm not really looking at from the bottom, really, right? because bottom would be a wrong thing to think. But overall in the journey, okay, what we started, right, in this calendar year, I would say, okay, we are still a long way to go.
You know, the other problem is when there are monsoons, the rain does not go. So in again Mumbai terminology, the monsoon here could be inflation. The monsoon here could be our over dependence on FI flows, and the fact that we are going through a patch where, in a sense, we are hostage to FI activity, aren't we?
That's true, actually. If you look at the run in the market also, I mean, why the market, people are surprised why the market has gone so much, right? When earnings, I mean, around it's still recovering, but not to that extent. So it's primarily driven by the FI flows. And I mean, that is, in fact, in India, if you look at the last 2 decades, right, there are only 3 periods, okay, when FI flows are negative. So traditionally, foreigners have been bullish on India, despite the various ups and downs what we've seen in the Indian markets, right? And that trend, I think, will continue. More so now because we are seeing a big emergence of emerging markets going forward. I mean, last decade was a decade for developed markets. Developed markets did fantastic, and the US, which was a large market, has given almost 12% return in dollar terms. I mean, India has just given around 3% returns. So actually, if you just come back, I mean, to ask a question, I mean, there is still a lot of room for India to expand going forward, right? Our dollar returns have been just 3%. So I would say foreign investors like growth, right? While globally we've seen growth recovering, it's only transient. It's been propelled by the fiscal stimulus, right, and the easy monetary policy in the developed markets. Once that starts to pull out, you will see growth coming down. India, on the other hand, has got structural drivers for growth going forward. I mean, we have given a fiscal stimulus, but not to that extent. We have cut interest rates, but interest rates are not zero, right, in India. They're still pretty decent. So I think in India, in the current context, if we grow at around 7-8%, I think India will be the fastest growing economy. I mean, the last decade, it was China, which was driving the growth in the emerging markets. I would say in this decade, it will be India which will be driving growth in emerging markets. China growth will probably be around 6% or so. And if that is the case, with the amount of liquidity which is there, and liquidity will chase growth wherever there is growth, right? So I think I see, in fact, last year, in the whole crisis, we saw FI flows in a calendar year were around $20 billion. And as the outlook for India and the narrative for India is looking good and growth is coming back, I would continue to see foreign flows coming in. And that would actually provide the liquidity. I think India is not only foreign flows, FI flows, but also FDI flows, which are important. And India is a capital-starved economy in a way. Our savings are not good enough. And even the capital markets require, companies require to raise money to fund their growth. So I think that whole liquidity which is there globally, I think will come in, and in a way it is a kind of a self-virtuous circle, right? You get more liquidity, okay, that funds your growth, okay, you get growth. So I think we'll getting into that virtuous cycle, and FIs and foreign investors would actually be feeding that.
Okay, Mahesh, if you're talking about trains, let's talk about food. And the current market is, in a sense, looking like, I feel like a kid in a candy store, because suddenly everything is doing well. IT companies are expanding, pharma companies are growing, banks have made a comeback, Asian Paints reported great numbers for the quarter gone by. Auto companies are saying that there is more demand and there is less supply. Every bull market has the leadership. That's what historical bull markets have done. Is this bull market different, or this bull market will also throw up its unique set of leadership stocks?
So if you go back and look at in the last decade, which were the sectors which did well? So it was technology, it was consumer, it was pharma, it was banking and financials. But within banks also, it was mainly the private banks, which are more structural stories. So it was essentially the steady sector, right? Okay, which high quality sectors, as you may call it, or more secular sectors, which were the leaders in the last decade. I think these sectors will also continue to do well. I think India consumption will continue to be a steady long-term story. IT sector also the outlook looks fine, but I think some of these cyclicals, okay, which had underperformed in the last decade, I think you could see a revival of those sectors. Again, it might not last out throughout decade because cyclical sectors normally play out over a 4 to 5 year cycle. But at least in the coming years, we see a resurgence of some of the domestic cyclicals. So that could be either the industrials, the capital goods sector, even the banking and financial services sector, consumer discretionary, auto. I think these are some of the sectors, okay, which would probably do well in the coming years on the back of strong domestic recovery, better earnings growth, and also some potential for re-rating because some of these sectors are still below. Their valuations are not really at astronomical highs as what we are seeing in some of the defensive sectors. So we are looking at some of the cyclicals really doing well, at least in the next couple of years.
Mahesh, are you pleasantly surprised with the numbers what banks have reported? Because at the peak of the crisis, it appeared that NPAs will go higher. Retail delinquencies would be in record high. Bankers themselves were running for cover. They themselves were raising capital. But look at the numbers they're reporting.
So yeah, I mean, during the COVID crisis, the bank stocks got beaten down the most, right, initially. And see, the banking sector went through the large corporate NPAs 2 years back, and banks were kind of stressed, and they're coming out of that. And COVID crisis actually put a test on the retail credit cycle, right, which had done very well. Last 10 years, retail credit has behaved very well. And this was a true test for the retail credit portfolio of the banks. And I think coming out of this cycle, we've seen that that's behaved fairly well, much better than expectations. I mean, overall NPAs, one would have expected gross NPAs to be around 4 to 5%. I think they would be around 2% or so. So I think the overall NPA cycle, especially the retail credit cycle, has come out with less scratches, I would say. And the recovery, the bank recoveries are now back to around 95, 97% or so, except probably in a few sectors like the microfinance sector or unsecured credit, and to some extent in the small and medium enterprises. But by and large, it's come out well. And I think the banking sector also, some of the large banks, they have been able to strengthen their balance sheet. They have raised capital during this crisis. The capital adequacy ratio is fairly large. And I think the whole banking sector is now really geared up, okay, to take on the challenge in terms of funding that growth, right? Credit as GDP growth picks up, nominal GDP growth. Next year, we're looking at around the mid-teens. Banks are ready to really fund that growth. And balance sheets are also, as I said, the total capital adequacy ratio is fairly good. So I think the banking sector is the core, right? Is the backbone of the economy and a large component of the market. So the way I see it, this sector, okay, would again continue to. It's already been leading the rally in the last 3 months, and that will continue going forward.
So what kind of orientation would you propose one should have in their portfolio, and where, and because we've got attendees who are also investors and distributors and your partners, so they would like to understand that what kind of positioning would you propose in the schemes which you personally manage and also your fellow fund managers are managing?
So I think another interesting trend, what we are seeing and what we believe will play out is that unlike in the last couple of years, 2-3 years, where we've seen the market was slightly more narrow, right? It was only the top 4-5 stocks which drove the market. I think the breadth of the market is likely to improve. And we've seen that play out in the last 3 to 6 months. And the reason for that is that we're seeing now many sectors firing. It's not just a few sectors which are doing well. The domestic recovery, what is playing out, will benefit the mid and small cap companies. And to that extent, you would see the breadth improve. And in that kind of a market environment, you would expect across the spectrum, large cap, mid cap, and small cap would do well. Obviously, the better companies and companies which manage their business well will only emerge winners over there. In that context, we would suggest a large allocation towards a multi-cap fund, right, which is able to play across the market cap spectrum. So a larger allocation should be in a multi-cap fund, followed by a large cap fund, because the large leading players will continue to do well. They'll go steady. And we've seen this theme of big becoming bigger, right? And especially after the COVID crisis, there has been a consolidation amongst the larger names. So that will continue to be a steady, but and some allocation to the mid and small cap sector would also be advisable, because one would expect the sector, the mid and small caps, which have underperformed in the last 3 years, will bounce back and could do better on the back of domestic recovery. And also for investors who are worried at this point in time, right? A lot of investors are worried what to do. I mean, rightly said, markets have rallied so much, valuations are looking expensive. Whether to invest into this market or to wait. So for those confused investors, I would say the best way to come through is a kind of an asset allocation fund or a balanced advantage fund, right? Where the fund manager really decides on the allocation towards equity and debt, depending on the market valuations and depending on the market cycle and the macro conditions. So I think that could be a good alternative for investors to look at if they are uncertain, because I mean, in there, the fund manager would decide on the asset allocation. And considering the fact that interest rates are low, I mean, I would say putting money into fixed deposits more than what you require for the next 2-3 years, okay, is not going to really give you even your inflation returns. So if you want to really put that money and worry about the market, then a fund like an asset allocation fund or balanced advantage fund makes a lot of sense, because there the volatility is much lower than a normal equity fund, and there the timing of the market is not really a question which you are worried about. And investors who want to take a slightly higher risk, right, like Nikunj, you, I think you are a higher risk taker, I would say. For them, I would say they look at thematic funds, right? So on the thematic side, one could look at banking and financial services sector fund. Is done well across the cycle. And if you really want to play the recovery, right, the broad-based recovery in the economy, I mean, that's a classic play on the economic recovery.
You know, I'm going to bring this point out since Mahesh called me a high risk taker. I would say that I am happy to digest not risk, but perhaps digest volatility. So Mahesh, let's spend some minute or two in discussing a classic quote which we've often discussed, but somehow a lot of people don't implement. And that quote is that in a bull market, the biggest risk is the risk of not participating. And in a bull market, more money is lost while waiting for the correction rather than when the actual correction occurs. We've seen that what happened to the markets. In the run up to the budget, they corrected 5%, but once budget was applauded by the markets have gone up 10%. Do you think that is one mistake? People who are attending this conference, people who are not investing right now and waiting for the correction that sasta hoga to lenge, are they missing on this lifetime opportunity? Because when the correction will occur, it may give you an entry point, it may not give you an entry point, but the correction is not going to be very severe.
Yeah, I think people have been waiting for that correction, I think, for the last few months. And that's been apparent in terms of the flows, what we are seeing into the mutual fund, which has been negative. I think waiting for that correction, you never know, I think, when that will come in. And see, you are waiting for the big picture, right? If even from here, okay, as I said, okay, we have not missed the bus. Okay, we are probably just about starting to make a beginning in terms of boarding the bus. The journey is still long away. And the returns in the medium to long term, as I mentioned earlier, looking at the kind of earnings growth we are looking at and looking at where the market is, in the P multiples are expensive, but on price to book value, market is still near this long-term average. So, so it would be important for investors to start investing. If there is a correction, you can put in more money, right? But if you just wait for that correction, I think it will, you will probably miss the bus, and then it's difficult to catch a running bus, right?
Mahesh, how would
I would say that SIP is the best route, I think. Many people have, I think in India, we've seen this SIP culture pick up pretty well in the last 2-3 years. I think I should continue to do that, because that has showed that even in investors, okay, I remember, I mean, we just look at the data, people who came in at the peak of the bull market, right, in 2008, and continued with the SIP from there, they have still made almost 10-11% returns.
Just make that point again, Mahesh. It's an important point. If you came at the peak of the bull market 2008 and then markets corrected 50%, you did not cancel your SIPs, you've actually made a double-digit return.
Yes.
So more money is So more money is made. I'm bringing this point out perhaps on behalf of Mahesh and something that is a channel which we endorse, that more money is made by spending time in the market, by not really timing the market. Always remember that SIP for an average investor is the best route. Mahesh, what should one not do in this decade? What are you planning not to buy, not to invest in, so that you can maximize returns? Because investing is also about avoiding mistakes.
Sure. No, I think what we have learned in the last years, many years at least in my investing, is that there are various opportunities you get in the market, but I think betting on the wrong company, betting on the wrong management is the biggest mistake you can make. I think sectors, you could see sector rotation happens. Okay, a sector could be bad for a couple of years, 2-3 years. Okay, it can come back. So I don't think I will avoid any sectors, right? A sector which is not done well in the last 2-3 years, probably it's time for it to invest. Like for example, pharma sector didn't do well for the last 2-3 years. And a year back, we went aggressive on the pharma sector. We launched a pharma fund that gave almost like 70% return. So I think the biggest mistake is to really backing the wrong company and the wrong management. And the markets have been very discerning, right? Wherever companies have failed on corporate governance, promoters have misallocated capital, markets have punished them heavily. And the Ps have derated and the companies have not been able to really come back. So I think that's the only, mistake or what I would stay away. Not only this decade, but that will be the mantra really to follow at any point in time.
There's two more follow-up questions, and something which just occurred to me 2 days ago, which is that we are comparing this budget to be a budget which is as strong as 1991. Should we remind everyone that after 1991, 2 years after the big budget, you had a big scam which happened on Dalal Street, and then there was coalition politics. Do you think this time, at least chances of that is not there, and this indeed is going to be a great path of recovery because of the budget?
So I think what has happened in that period, I think our systems have been strengthened multifold. I think both our regulators have been really prompt, and actually we have much more regulation in India than probably in some of the developed markets. I'm just looking at our retail. Some of the markets like in China or other Asian markets, we've seen the huge amount of retail money coming in the US, and that money has come on leverage, right? Because the financial institutions there are providing at low interest rates. And that money in India, we haven't seen that. Our regulators have been very, very tight in terms of curbing that. We have seen new norms coming in terms of margin funding. So I think the way the regulation has shaped up in India and regulators have behaved, I think we are much, much ahead of the curve. And I don't see those kind of mishaps what we saw, right? That typical problem when in a bull market, right? In a real bull market, when there is amount of liquidity, okay, you can see those kind of scams or those kind of bubbles which get created, and then there's a big bust and there is a huge despair for investors. I think we are trading very, very cautiously a regulator. I think I don't see that bubble at all. Even the market where there are, frankly, I'm not seeing any bubble, at least in terms of domestic retail investors.
Just to wrap it up with one more point, Mahesh, and I'm going to challenge your point on retail investors. When you see an episode like GameStop, when you see a social media forum, investors and traders, they come together and they can, even the price of silver goes up and down. When you see the excitement in the euphoria in the IPO market, don't you get worried? Because the masters of the market always say, beta do cheez ka dhyan rakhna. IPO market ka euphoria or retail participation. Right now we have both.
Yeah. So see, there is some amount of retail, but by and large, if you look at overall, as I mentioned earlier, there is some amount of euphoria. We see retail money, retail investors coming directly into the market, and that's been reflected in terms of new mutual, the demat accounts which have been opened. But overall, if you look at it in the gamut of things, at least I'm not seeing that euphoria. It's not leverage money which is coming in a big way. So while I'm worried when retail investors chase some penny stocks, okay, and that goes up, and we see what happens to those companies. But I think investors should be aware and careful, and that's the reason why I think they should give money to professional managers. And I think it is high time that you see money outflows what we see in mutual funds. I think what has happened is that the sharp rally in the market has emboldened everyone. Everybody thinks that he can make money quickly, right, in the market. And that's what has led to this retail participation. But I think markets are not going to be the straight rally what we have seen. You will see some pullbacks, correction in the market, some amount of volatility will creep in. And I think it's best to really put money in the hands of professional managers. And there are various ways you can actually do this. There are multiple funds, okay, with different risk appetite which you could invest into. So yeah, I would say retail investors should really be cautious at this point in time because everything is going up. We're still not really into that bubble phase, but you might go there, and I think it's advisable, okay, to be cautious.
You know, before I wrap, I know Sumit had a question. I can preempt his question because we've been working for years now, and Sumit wants to know, Mahesh, that which is one non-Birla scheme you would advise people to invest in?
I would say you put money in our asset allocation fund. Okay, we have a multi-asset fund. Okay, where you will get where we not only invest into Birla funds but also outside Birla funds. So I think that's the fund you could look at.
Sumit, I hope I got the
question. Really get into that track, yeah.
Well said, sir. Thank you so much, Nikunj sir and Mahesh. If you're done, thank you so much for that. Well,
thank you.
That was okay. Maybe one of the questions at the back of my head, at the back of my mind. Nikunj is really great at reading our minds, but but Mahesh, you actually answered my original question earlier when you said this is the journey is at Lower Parel if the equity markets are going from Churchgate to Kandivali, if that is the whole path, we're at Lower Parel. So we've got some kind of idea of where the markets are headed. All right, that was a great session. I hope everybody enjoyed it as much as I did. Before we move on, it's time for our champion of the 8th Wonder quiz. Just like yesterday, a question will pop up and you need to do some calculation and fill in the answer. So you have 1 minute for that. If you know the prize you will be winning, the winner will get a prize, which is Gautam Baid's book, The Joys of Compounding. All right, here is the question for you. It must have popped up as well. Ram started saving for retirement at the age of 30. Ram started saving for retirement at the age of 30 with an SIP of 10,000 rupees per month. Sham started saving at the age of 40 with an SIP of 20,000. If both retire at 60 and both investments earn 10% per annum, who will make the bigger retirement corpus and by how much? All right, I'll say that once again. Ram starts saving at age of 30, SIP of 10,000 per month. Sham starts saving at the age of 40, SIP of 20,000. So it's 10 years later, but his amount is double. If both retire at 60 and both investments earn 10% per annum, who will make the bigger retirement corpus and by how much? The question must have popped up on your screen. You can fill in your answers and submit it. And like we did yesterday, at the end of the day, we will announce the winner of this contest. It's all about the power of compounding, as it's famously called. It's the 8th wonder of the world. Well, I hope you've been answering that question. Give you another 5-10 seconds. In the meanwhile, keep tweeting, keep sharing your thoughts with us. The hashtag is Voyage2021 and the handle is ABSLMF. All right, this is day 2 of Voyage. I will just close the poll now and we've got all your answers. We will get back to that later in the day. Moving on, let's move on with our session today. Now, interest rates are at a historic low levels, leaving conservative investors who prefer relatively lesser volatility looking for reasonable alternatives. But with a self-balancing asset allocation portfolio, Aditya Birla Sun Life Balanced Advantage Fund could just be the answer they seek. Watch this video to understand how it works.
Aditya Birla Sun Life Balanced Advantage Fund, a scheme of Aditya Birla Sun Life Mutual Fund. Ever seen a rope walker performing along a rope? The artist maintains an impeccable balance while walking along a tensioned rope between 2 points using a balancing tool, pole balance, to maintain equilibrium. Similarly, Aditya Birla Sun Life Balanced Advantage Fund endeavors to strike a fine balance between growth and safety by investing in a combination of equity and debt instruments, no matter if the market is up or down. It uses a valuation-based PE model as a balancing tool identical to a rope walker to manage volatility across market cycles. A dynamic asset allocation approach enables active portfolio rebalancing. With a portfolio mandate of having a minimum gross equity exposure of over 65%, the fund offers scope for capital appreciation and better tax efficiency, and reduces downside risk by taking exposure to derivative instruments through portfolio hedging. The fund uses the blend of both top-down and bottom-up investment approach to select stocks across different market caps with reasonable margin of safety. On fixed income side, it invests in debt instruments across credit spectrum to benefit from better income generating opportunities. So, if you wish to add balance to your portfolio, invest in Aditya Birla Sun Life Balanced Advantage Fund, an all-season scheme that offers potential for growth with reasonably lower volatility with equity taxation. For more information, call 1800-270-7000 or visit adityabirlasunlifemf.com or contact your financial advisor or distributor. A scheme of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
All right, this is also one of the schemes, in fact, that Mahesh was talking about when he shared the equity outlook for Aditya Birla Sun Life AMC. But moving on, our next set of speakers will be sharing their portfolio strategies for the way ahead so that we get some specific guidance. Here's a look at the next set of speakers today. All right, joining us on this next panel are Senior Fund Managers Equity Investments at Aditya Birla Sun Life AMC, Ajay Garg, Satyabrata Mohanty, and Anil Shah, and they will be in conversation with ET Now's Aisha Faridi. Over to you, Aisha.
Thank you so much for that, Sumit. At a time when you've got the markets almost rising up like an albatross from the ashes, from the March lows, you really wonder as a portfolio strategy whether there is any need to realign or not. And we've got three experts today joining in from the House of Aditya Birla Mutual Fund to really analyze that. They represent value, growth, and quality. So I'm going to dig deeper as to how is it that we can realign our portfolios. Gentlemen, evening, and evening to all of you tuned in this evening as well. Ajay, if I could start with you, why fix it if it ain't broken? That's the question at every portfolio investor's mind right now, that you've seen such handsome returns. The market has time and again told you that irrespective of any hue and cry, of any calamity, pandemic, whatever it may be, the market is a future-looking beast. And that's already priced in the growth and the economic recovery. So do you really need to realign your portfolios at this juncture?
So, Aisha, you are right, actually. So what we saw in 2020 was a rally immediately after the COVID broke out. That was on 23rd of March last year. We made a bottom, and we rallied post that. There were a couple of reasons why we rallied. Initially, it was pushed by the governments, helped by the governments globally as well as locally, and secondly, it was like people, lot many people, lot many services or jobs they could do work from home rather than being in office, and mostly from the services sector, except for hospitality. And a lot many companies, they changed their business model and somehow adapted to that new culture that enabled them to work seamlessly without their employees moving out of their home. And in the process, what happened was like people were saving money at that point of time because they were not traveling out, they were not spending on in restaurants, not going out for entertainment, and that extra money got invested into the equity market. So in a sense, like it climbed the wall of hopes and or worries, and now what we are seeing is like slowly workplaces are opening up, and as vaccines come into the market and people get vaccinated, that fear of going to office will slowly go off. Some part of the work will be done permanently from home, which people have adapted or the companies have adapted very well. But what will happen is like less money will go to the stock market directly, and it may go to the companies, or in the sense like people will spend, people will go and shop, people will go and entertain themselves, go to the restaurants, and so the health of companies will improve. So what will happen is that last year the health of companies were looking quite low, and people thought it is a bubble in the marketplace, things are not working well, but the stock markets are rallying hard. So what we have seen time and time again, that markets tend to align with reality. So less money to invest in the stock market directly, but more money to spend. And so what will happen is like fundamentals and technicals will tend to align, or 2021-22 mid will be a period where reality check will happen. And so that way it is.
Anil, I want to get you in here. While Ajay has established that yes, there is a need to now realign your portfolios. The traditional debate in the equity markets has always been about value versus growth, and we've time and again seen, at least in the last decade or so, that it's growth is one. Right now, what you're seeing is momentum in the markets. I mean, the famous dialogue on D Street is risk hai to ishq hai. I know it's a leaf out of an OTT series, but really, everyone seems to be throwing that dialogue every now and then, that, it's all about momentum. What out of these three is going to win eventually? Is it going to be growth? Is it going to be value? Or would you say, don't use your minds, there is no valuation metric in this market, just ride the momentum?
No, I don't think, we can generalize, just to play momentum. Yes, in the short term right now, when we see a lot of money chasing, returns basically across the globe, right? You have very, very low interest rates. You have huge amount of fiscal and monetary stimulus, depending on which country we're talking about. And the most fungible thing in this world is, like money, capital. It just moves. And we're seeing huge amount of inflows in India. So it clearly seems like a large momentum market. But let's not forget that, from an India perspective, we managed the COVID pretty well. Nobody had expected growth rates to have bounced back the way we've seen growth rates, consumption, infra spending, etc., coming back so quickly. Nobody had anticipated, it's been almost 5 or 6 years, we've tried fiscal consolidation as far as this government is concerned. We've now taken this opportunity to say that the priority is growth, and we've given ourselves a 5-year room window where we are okay with some higher fiscal deficit. So, all these things will lead to better growth rates, I think, and hence better valuations, better earnings growth, most important. I think the most important underlying statement that we need to make is earnings growth. Eventually, it all boils down to earnings growth, and earnings growth. If you go back to the last 5 years, we've always begun, the year with a lot of optimism, and most analysts on the sell side, buy side, across would pen 15, 17, 18% earnings growth for the country. But, we've landed up with probably single digit, and in some cases negative earnings growth for the last 5 to 6 years. But now with the change in terms of the environment, the momentum, the positivity which is there, and as I said, the change in policies, as we're assuming, lower interest rates to remain for a longer period of time, there is a genuine hope of a sustained growth and hence earnings to come back. And I think that's the message. That's the point that we need to make. It's just not all momentum. It's obviously based on certain certain assumptions. The call to make really is going forward is, will those assumptions come true? But and that's what investing is all about.
So you're the value guy here. What's happening in the market right now is that the market is already pricing in those strong earnings growth as well. Time and again, right now in the Q3, we've seen that irrespective of the highest revenue and highest profits, the markets are not rewarding those stocks because the stocks had already run up in anticipation of those high earnings growth. So this entire debate about what is it that you need to go for in the longer term, is it value, is it growth, or do you just stay with momentum? Which side are you leaning on?
Yeah, you asked me.
Yes, Satya, you.
Yes, the market tends to bucket everything on this growth and value thing, and they keep on debating what is growth and what is value. But the thing is that the way I would like to put it is that there are certain investment ideas which are structured and certain investment ideas which are cyclical. And so personally, what I do is that my bias is towards investing in more structural ideas in sectors which have strong tailwinds behind them. And even when I go to the cyclical ones, they're also cyclical. I will not go purely based on value. I will also look for growth in those cyclical needs. So I'll only go to cyclicals which have growth coming, pricing in of growth. And my view about the equity markets is that see, everybody has been talking about that the markets have gone up and they're moved away from reality and everything. But the fact is that anywhere, if you have a large fiscal stimulus, as large as fiscal stimulus and as large as a monetary stimulus as we are having now across the globe, and even now in India, the fiscal stimulus has come after the budget. Fiscal stimulus leads to increase in corporate profitability. Corporate profitability leads to increase in corporate investments. So it creates a virtuous cycle. So the only risk in this whole thing is that this large fiscal stimulus and large monetary stimulus, will it lead to inflation? That is what we have to look out for. But that's the only risk. As of now, I don't think anybody is factoring any kind of inflation in the near future or in the medium term. So I think that is why the markets are where they are, and while most of the professional investors are still positive in the market going forward for the next 2 to 3 years. And in this kind of scenario, I would still prefer to invest in the long-term structural trends that are playing out. I don't think anything has changed to stop those things. Yes, value will rally; they will come. But the thing is that you have to think whether it's a short-term investment or the long-term investment. In the short term, or value might outperform. Maybe it will outperform growth in the short term. But longer term, I think growth will tend to outperform the so-called growth.
Okay, I'm glad you made that caveat. But Ajay, this debate can go on and we can go hours discussing about that. The fact that Satya was saying that, yes, there is the domino effect of inflation when you have such large sizes of stimulus. But going by the last commentary of the RBI governor, it seems that the RBI is going to take whatever it takes, even if it be at the cost of inflation, to try and keep the economy in the growth territory. Where is it that you find value in such a scenario? And would you believe that cyclicals will continue to be in favor, irrespective of the inflationary impact?
So inflation can be there. It can be. It may. I feel if inflation is going to be there, it is going to be very, very short term in nature. The reason being, especially since mid of or 2015 or so, we actually evolved into a technological world where new technologies are coming up, and the inflation is almost getting killed. So it may be local to few geographies, But on a global scale, probably inflation, you may not get inflation for a really long time, helped by technology especially.
Sure, that's on inflation. But what about cyclicals? Will they continue to be in favor?
So cyclicals are more related to inflation actually, and the reason why they are called cyclical, so they are short-term in nature. So I'm more of a secular person where growth can actually be seen ahead and year over year, rather than it is a one-off or a 2-year phenomenon.
Anil, is there need to tactically realign your portfolio? Are there pockets that you need to now say, I've made the money, it's now time to get out and increase allocation somewhere else?
Again, I won't use the word tactically, but yes, sure. There is, you have to sit back at all point of times whenever there's an important event or an important policy, globally or locally, and you need to really understand if it's going to really change the earnings trajectory for a particular sector, stroke, a particular company, and if so, sure. Then should it be a part of your portfolio if it's not already? So yes, as I said in my earlier conversation with you, I think clearly, without a doubt, India is moving towards a more focus on growth, be it from the government or be it, from the RBI itself, as you yourself mentioned. And within that perspective, with the kind of, interest rates that we are looking at right now and likely to continue, even if it moves up, we are unlikely to go back to the old interest rate regime that, we were in with very, very high levels of interest rates, choking demand and choking, further investments. That's unlikely to come through, at least in the medium term. And if keeping that in mind, there is no doubt that you will need to realign your portfolio to some degree to accommodate some of the stocks that you may have not earlier bought.
To those some stocks that you may not have bought, Satya, are there newer pockets that you may be looking at? Home building, materials, real estate. I mean, is that the deadly combo for this year ahead?
Yeah, I agree with what Anil said. Because circumstances are changing, so we need to tweak our portfolios and fine tune it to the emerging trends that are coming in. The thing is, the way I would like to do is that if I go to, I'll look for cyclicals which are offering more growth, and I look for growth companies which are relatively cheaper compared to the other growth stocks. So that is how I would like to place the portfolio at this time, tactically or maybe for the medium term. And see, another thing, as you said, real estate and everything. I think real estate is looking positive, and a lot of people are positive. So, but the way I would like to play it is there are a lot of sectors which benefit from real estate, like you said, tiles and the consumer durables, etc., benefit from real estate, increase in real estate. So, my personal style is I would prefer to play the sectors which benefit from real estate rather than investing directly into real estate companies. And it's something like, suppose if infrastructure, a lot of people are bullish on infrastructure, but benefit from infrastructure, apart from infrastructure companies, comes to certain other sectors also, like cement and other sectors. So I would invest in those sectors also. So as the government is spending on infrastructure, so these sectors will be in flavor going forward. So we need to tweak it. The thing is that we have to be mindful of the quality of investment that we make, because certain cyclicals tend to have a huge beta, and they create instability in the portfolio going forward. They might give you short-term return, but long-term they might create problems inside the portfolio. So we have to be careful of what are the type of stocks that within those cyclical sectors we buy. Other thing that I believe is that in India, you typically don't have those so-called growth sectors that you define it in the development. In India, hardly there are typical. What are the structural sectors really? They are staples, they are maybe healthcare. Rest everything is cyclical in India. So they exhibit characteristics of both being structural and cyclical. Like banking and finance is structural and cyclical in India. Like consumer discretionary is structural in India because the penetration is so low, but still it is cyclical. So a lot of sectors in India are show both the characteristics. You can't say that in India I will not invest in cyclical, because then you are limited with only 2 sectors.
Yeah, absolutely. Talking about growth, though, on a large cap IT and pharma, good old 2 sectors. Now, I don't want to get into the debate about valuations, but I just want to understand whether they're still good to go for more, or would you say try peter out of that because they've already had such a good run?
No, I think good to go for more, both the sectors. But again, you should be clear in terms of your timelines, in terms of what are these. IT is clearly extremely secular. At least the Indian IT software companies consistently have been showing higher single digit volume growth, and at least higher I'm saying a lower double digit earnings EBITDA growth. They are absolutely good free cash flow machines. They are very, very good balance sheets, excellent managements, and India, as we know, is the hub for software, or offshoring as we call it. So I think these are companies which are here to stay. These are companies which are growing in size by leaps and bounds year after year. And the world is embracing us and has managed to embrace us over these most difficult times also over the last many years. But offshoring has remained and growing. So I think that's a sector which should be a part of one's portfolio without doubt. As far as pharmaceutical is concerned, again, it's one of the few sectors where India has got its core competency from a global perspective. We are the global hub for generics, so-called copycats, if you want to name that. But that's a sector where primarily 90% of the companies are debt-free. Again, very, very good free cash flows. Again, the world probably, there's not a single corner in the world where we don't export our generics. And it's a sector which is, pretty much always going to be there. It's I won't use the word evergreen, but it's a sector which is there, either from a precautionary health perspective or a post perspective after an ailment. So I think it's a sector which is going to be there. It's consistent in terms of its growth rates, and it's a sector wherein you should be invested, particularly in healthcare. It's just not again generics. You could look at hospitals. You could look at pathology labs. It's a wider sector rather than just putting it as a pharmaceutical company. I think it's more healthcare related. I would use the word more healthcare, in which you can get all of these as a basket. And yes, you should be invested there. And I think there are lots of more legs in both these sectors to go.
Right. Ajay, how worried are you about the inflationary impact of commodity prices going on? Because, we're in the midst of Q3, although at the fag end, and, whichever company that we chat with has hinted towards, the inflationary impact of commodity prices going up. And if they aren't unable to pass it on to the consumers, then that could have a dent on the margins eventually.
Most of the companies that I have in the portfolio, they are not much affected by the commodity prices. The reason being, there is a significant value add of the within the company or by the management. So commodity prices per se, they don't affect much my set of companies where I have investment in. So it is more of a value add from the company side that actually translates the company.
Anil, how convincing is the financial story? I mean, as recent as today, we've got the news of Aadhar Poorawala and Magma FinCorp. But that aside, I mean, clearly gives you conviction on how strong the entire NBFC story is within financials.
I think, as far as financials is concerned, again, the country's growth rate, if we need to grow, finance is the lifeline or a bloodline of any economy for that matter. We are, as far as the country is concerned, again, our saving rates historically have always been high. Of course, they've come off in the recent past, but we still remain a reasonably high savings country. And from that perspective, the penetration levels of being leveraged have not been high. Of course, with the newer generation, and with the growing spend that people really want to do on, living better and better quality of life, you will see the penetration improving. The prospects of financials in general, and particularly well-run NBFCs, is always going to remain. It's going to be, there's an NBFC out there with a very, very good track record, good policy framework, and good risk models in place. I think there is growth for him to take. As far as in a country, of the size that we are, and the kind of fillip that the government and the RBI is unleashed on for growth. So I think there is enough and more for NBFCs, or for that matter, finance companies to take. I think the key point here is your policy framework should be perfectly in place, your distribution should be out there, and most important, your risk models need to be well tested. And I think, in the last 4 or 5 years, the men have been separated from the boys as far as the NBFC is concerned. We've seen enough and more of, hiccups which have come along the way, starting from demon to, various other things, and last but not the least, the pandemic. So I think, it's very clear which of the few NBFCs out there are really, really going to be the giants of tomorrow. Some already are, by the way.
Right. I must tell our viewers who are tuning in right now that just the other day when I was chatting with Anil and talking about valuations being rich, and he said, valuations, what's that? And for a second, I didn't get the joke. And then he's like, what's that? So valuations clearly not being a concern. But Ajay, are you worried about valuations being ripe in any of the pockets? And then would you want to switch to maybe more bottom-up stories, which is more Satya's style?
So Aisha, you are right. But what has happened is helped by the budget, not many sectors. There was a last sector which was remaining, which was not, which was requiring some sort of help, which was infrastructure. So it got helped by the PLI schemes announced prior to the budget, and also there was in the budget there was a lot of announcement about infrastructure spend. So what has happened is post that a lot of these sectors have reflated, or the stocks have reflated. So I would say it is a level playing field, and consumer stocks have come off in the cyclical rally. So on a comparative basis, I feel sectors are not, most of the sectors are well balanced in terms of PE multiples. So multiple of consumer stocks have come off, whereas cyclicals, they are still, they have run up. In anticipation, the spend is going to happen and it will convert into profits. So looks like in all likelihood that the volatility or sector rotation what we saw till now, probably we will have less of sector rotation, and it will convert into a bottom-up stock picking. And I'm a stock basically bottom-up person, where I don't believe in sectors, because once we talk about sectors, so then we don't differentiate between two companies. In fact, when the valuations are high, there has to be a significant USP about a company. So most of the companies that you'll find, or one will find in my portfolio, will be near monopolies or market leaders. So there will be a significant USP about that particular company, whether it is in automation or agri, or even for that sake in financials. So we tend to we have been able to find leaders in the category, but somehow not by design but by luck, the portfolio happens to be well diversified.
I could see Satya smirking. Yes, Satya, I mean, world over, it's the large is only getting larger, and it's becoming a giant whale. I mean, I can go on with the list from an Amazon to a Tesla, and on and on and on. Similar has been the theme in India as well. But since you're the more bottom-up guy, where are the hidden gems in this market?
Yeah, where we get that last part, I didn't get it.
No, I was just wondering, where are the hidden gems in this market? What are those bottom-up undiscovered stories?
What I would say is that why are you going to looking around for hidden gems when there are gems which are there in the open? As you said, large are getting larger, and that is one of the major trends that are playing out across the globe, both in developed worlds and in India also. It's mainly to do with, in the Western world, it's mainly to do with tech companies and the network effects that tech companies have. And in India, it is more to do with formalization of the economy and access to credit, etc., that is there with the larger ones. So that is why that's a trend that is happening in India. So see, as far as hidden gems, if at all, if I have to go and find hidden gems, I think hidden gems are there in the tech sector in India, which are currently in the private space. I am not talking of tech. I would differentiate between IT services and tech. In India, we tend to confuse both, but IT services are separate and tech is separate. Tech is mostly, apart from 2-3 companies, are in the private domain. And I think this year you will see a lot of tech companies coming in for IPOs. So that is when public investors have to get used to investing in companies with valuations which maybe they're not used to. Maybe investing in companies which don't make money with multi-billion dollar market cap. So I think that is where the hidden gems are, which till now the public investors don't have access to. But going forward, I think we will find a lot of companies which are coming at 4 billion, 5 billion market cap. You might think that they're okay, that's already 5 billion or already 10 billion. But the trends that are getting amplified because of COVID, I think there is significant upside in the tech space in India going forward.
Let's call them digital enablers, for the lack of a better word. Okay. Anil, just wanted to get your sense as well right now. I mean, mutual funds are like medicines and food. What suits me doesn't suit you. What I like, you don't like. My needs are different than yours. Is there need to prima facie try and realign your portfolio, ease off on the large caps, increase small and mid cap exposures? I don't know if it's a fair question to ask you.
No, in the sense, look, when you look for companies or sectors, you're looking for growth, you're looking for good managements, you're looking for you're looking for what's the moat in a particular company, what is it that this company can offer which is unique, which is a major strength, and which you think you want to invest in. And the most other important part when you invest in a company is the scalability of the business, right? I mean, that business needs to be scalable. We call India, and of course the globe from an exports perspective, but India itself is pretty unique as a country. What sells in the East, one has not even heard in the West, and vice versa when it comes to South and the North. So the country really, scalability is important, whether it's a product, whether it's a service or whatever it is that the company has to offer. So, as a fund manager, you really need to look at all these issues and things and then go ahead and invest. The last thing that I really do is look at, is this a small cap or a mid cap first? So I don't really go out looking, while I do manage the flexi cap and the mid cap fund. But you really don't look at a company just because it's a mid cap or a small cap. You look at a company for various reasons that I just talked about, and then ask yourself, do you really want to invest in that? And if the answer is yes, you buy it. Luckily for me, flexi cap is now completely flexible, which means there are no boundaries in terms of how much I can have of small, mid, or large for that matter. It could be, it could be anything across. And of course, mid cap, there are SEBI guidelines within which one needs to operate and within which one is functioning. But, I think the way to look at investing is that versus rather than, looking at, going out in the marketplace and looking for a small cap and then investing. I'm just clarifying that. Having said that, I'm sure many fund managers, many experts have come and always said this, that the large caps are much more better researched. They have larger board of directors, board advisors. Yeah, that goes with the territory because they are large caps. And they're always under the public eye versus a small mid micro cap, is not necessarily being seen or evaluated or analyzed to that degree, to that extent, and not in the public eye. So the risks are obviously going to be higher. But having said that, that's where that's where the new winners of the new large caps are going to emerge from. So you need to keep looking at everything that comes your way. But as I said, besides the obvious things, which is, management, growth, the first thing that you really need to look at is the business scalable? I mean, to me, that's the most important thing.
Ajay, you want to add something there?
So I do agree with Anil, what he said, and most of the things even I follow, and it is all about not whether the company is small or big. So we saw a company, basically large caps can become mega cap, and even then they will remain a small cap in a global scheme of things. So it is all about the size of opportunity, how management thinks, and can you think exponential. So one more thing I would like to add, till mid of the last decade. So it was kind of people used to track the CAGR part. So starting from mid of the decade, the thinking has to be exponential. So most of the tech companies globally, if you see, their thought process has been exponential. They have been able to grow exponentially. They have been able to capture market share exponentially. They have been able to kill 8-9 industries by one stroke. We use mobile. So if you were to think why it is called mobile, it is actually you don't need a car. You don't need to travel to a bank. You can just bank on the mobile, right? Which is another. It is called cellular phone, or it is called a mobile. So one needs to think very differently in this digital world, and build the portfolio accordingly. So there will be lot many, as Satya pointed out, there will be lot many technological companies which will come, and a few of the global CEOs are from India. So you will have companies from India, for sure.
Satya, you have something to add there?
Yeah, see, unlike both of them manage the mandates are flexi cap. So in both the tax scheme and Anil's in the flexi cap category. Unfortunately, I manage a large and mid cap, which has rules and bounds of how much I should invest where. So if one of my mid cap picks converts into a large cap, then I have to go and search for another mid cap so that I maintain the 35% minimum exposure to mid caps. So I definitely aggressively look out for mid caps. But the thing is that for me it's a mid cap because the market cap is lower. Otherwise, everything else is the same, whether it's a mid cap company or a large cap company. It's the same thing that we look from the companies. It's not something it's different. Maybe for small cap also we look. It's the same way of picking up stocks. So apart from that, I think I agree with what both of them are saying. If there is no regulatory constraints, you should actually look at stocks on their own rather than a large cap, because as I said, one of the trend is that large is becoming larger. As you said, that's a trend globally, and you don't want to move out of that trend at this point of time. I think still there are levers and a lot of forces which will make these large companies much more larger, unless, of course, there are regulatory constraints that come in the US, etc., to control the tech companies, which is a risk for those tech companies. I don't think those risks are there in Indian companies. In Indian companies, large companies are getting larger.
So I would like to add to what Satya said.
Sure.
Historically, as a house, we have picked up a lot of, there are many examples. They are still sitting, and we have still investment in those companies. When we picked up, these were small caps. Even, in fact, if I remember correctly, one or two of them, they were micro caps. They were merged as large caps now. So
catch them young and see them grow.
Yeah. So it is all about stock picking and fund management. So it is all about that.
Indeed it is. But Satya, before it's time to wind up and take perhaps some of the audience questions as well, just one question. The entire global auto recovery theme has been playing out, and domestic theme as well. What started off with rural has now spread its wings across, almost touching now or pilfering through to the CVs as well. Considering most auto anchs fall into the small and the mid-cap category, do you believe that this is a theme which is here to stay, or do you think come EVs, this is going to be challenging?
See, definitely auto companies is that it is EV that is expected to dominate going forward. And we have to look for auto component companies which are not at the threat of EVs, because Ajay knows that he has studied it thoroughly. The components in an EV four-wheeler is significantly lower than the number of parts that are used in a normal vehicle. So in that sense, a lot of business will go away. But there are certain good, high-quality auto component companies which are not exposed to this threat. So I think we have to be selective. The opportunity is quite large if you take care of this. So Ajay, I think you'd like to add something there. The kind of companies, auto component companies. I think Ajay owns quite a few of them.
So Aisha, so if you would have asked me a question on autos, I would have said I have a significant exposure to autos. If you would have asked me a question that are you bullish on autos, I would have said probably no. So
okay.
So how I played out autos, I'll tell you. There's few things that are going to remain common when the transition happens from ICE vehicles to EVs, to autonomous cars, to even autonomous cars. Paint is going to be required, right? And tires are going to be required.
Yeah.
Seat belts are going to be required. Airbags are going to be required. So you need to think on those lines. What all things are going to be required and are going to be common when the transition happens?
Sure. I think you've given us a list of companies without even mentioning them as to what within the auto ancillaries one really needs to focus on. Another one space that we haven't spoken about is commodities. Again, a beautiful rally has played out globally as such as well. The price hikes continue over there. But is commodity still a good place to be in? Or would you say that it's priced to perfection? Although you don't believe in the theory.
No, I think... why commodities? If you look at any stock today, as we speak, and on current earnings for FY22, it's priced to perfection and probably beyond. I don't think it's just commodity. I think the important call in this particular rally is this the beginning of a new growth phase from a country perspective, which is likely to lead to profitable earnings growth for corporate India over the next 3 to 5 years. And I think if the answer to that is yes, then there's a long way for commodities to go to, because it cannot just be that there will be demand for consumer cars and consumer durables, because to make those you'll need steel, you'll need aluminum, and you'll need everything else. So the important call really is that are we looking in this right now? Is this growth sustainable from the next 3 to 5 year perspective? If the answer is yes, I think commodities has a lot of juice still left. I hope I've answered your question.
You have. Ajay, just closing comments before we wind up.
So I think Aisha's something's gone off with the footage, but if we can just give the closing comments, if we can start off with Ajay, if you'd like to go first.
So from my side, I would say last year when we did a voyage in the month of April or May, that time equity was looking a bad place to be in, and the question was why equity? Why not fixed income? Why not gold? Or why not silver? But I just and that too on a 5 year and even beyond that, returns were looking a bit low as compared to the other asset class. Just check the returns of the previous asset class and the equity category, and the surprise part is like 10-year returns, 5-year returns, they happen to be mid-teens, and even 3-year returns, they are not looking bad. They are almost touching double digit. So this is the power of equity. So my advice will be to run a balanced portfolio, maintain a balance, consult your advisor, and do a proper asset allocation. So what will happen is like you will not panic when the world panics.
Fantastic. I bet Ajay, I bet nobody's asking you now why equities. I'm sure everybody's on board for that. Satya, can we go to you while Aisha joins us back? Satya.
Yeah.
I'm back. Can you guys hear me?
Yes, yes, Aisha, we can hear you. Okay, good. You're back. So I was just taking it ahead from where you said. So I've got Ajay to give his closing comments and Satya, and then back to you.
So my final comments would be that, Aisha, you're telling something.
No. Go ahead. I was just wanting to say that, maybe I should have discussed telecom considering my link snapped, but Satya, go ahead.
Okay, so my final comments would be that, my take is that, we have seen unprecedented level of fiscal stimulus, which is coupled with unprecedented level of monetary stimulus, which I think will lead, which always leads to increase in corporate profits, which the market is seeing and anticipating. So, and I think this will go on for quite some years. So going forward, I think the markets will be positive. You may not get the kind of returns that you got from the bottom of the market, but still, I think it will be more than the average that you have that equity markets have generated. The only concern that I would look is that this kind of fiscal stimulus always results in some inflationary pressure. And if there are inflationary pressure, then we should look at investing in companies which have pricing power. So that eliminates few commodity type companies which don't have pricing power. And as far as equity allocation goes, historically, whenever there has been inflation, equities have always outperformed bonds. So I think there should be considering where the bond yields are and the expectation of inflation if they arise and they arise going forward. So then I think the only way to hedge is to have a larger allocation to equities than you normally have.
Anil, would you concur with that view? Interest rates on our side, you've got the FII money as well pouring in. It's still very much intact. Besides a few odd corrections from the current levels, would you say that the returns for equities are going to be pretty much intact, or would you say that we must have a more modest expectation for 2021? It's obviously not going to be a replica of 2020.
No, I genuinely believe that nothing goes as per the script. That's the way the world is. That's the way it is. So let's all just rejoice 2020 for being safe, for having invested, for having made our money, and look forward positively to 21. But at the same time, let's not be greedy. If there is return on the table, take it. But as you rightly said, don't expect a 2020 to repeat.
Okay, on that wise note, we're going to call it curtains down on this particular panel. Sumit, I'm going to hand it back to you, but stay tuned. We've got lots of exciting panels lined up ahead. Sumit, over to you.
Thank you. Thank you so much.
Thank you.
Thank you so much, Aisha, and thank you, Ajay, Satya, and Anil. Wise words from all three of them, and I really like the last bit where Anil said, "Don't be greedy." All right, so don't be greedy. Stay in it for the long term and keep building up. All right. So to all our attendees, to our viewers, do remember to keep your comments and suggestions coming by tagging us at the rate ABSLMF and using the hashtag Voyage2021. Do remember the prize for Smart Twitterati and for Active Learner of the Day are still up for grabs. You've got to keep tweeting, keep sharing your relevant tweets, your relevant comments and questions. All right, joining us on this panel are 4 fund managers and senior analysts from Aditya Birla Sun Life AMC, Nitesh Jain, Dhaval Gala, Kunal Sangoi, and Chanchal Khandelwal, and they'll be in conversation with ET Now's Abha Bakaya. Over to you, Abha.
Thank you for that, Sumit. Good evening, everyone. Great to have all of you with us. I wanted to get started with an overview, really, of the fund, how you go about the selection process, what your outlook really is. It's a lot of questions all bunched into one, and I know all of you will add a different perspective. But to begin with, Nitesh, let me come to you. If you can share with us really an overview and why the small cap fund, what the thought process is, and then we can dive in from there.
So essentially, since last 1 year, the small cap fund, the Aditya Birla Small Cap Fund, has been managed by the analyst team. And as you may be aware, as a team, we are like 10 people covering different sectors. I am a sector generalist covering the mid and small cap stocks, apart from a couple of sectors. Effectively, what we have done as a process is a certain allocation for each and every analyst is there, and only the high conviction absolute return ideas are part of that portfolio, and it brings 10 minds together, and to get the maximum out of it, this is the target. And broadly, we are on track. The team collective efforts are now visible. And compared to, a bigger change is that instead of mirroring the small cap index, now we are focusing more on the absolute return bottom up ideas. Yeah, that's all.
Okay, great. And we're going to talk more about that in a lot more detail, get into specific sectors as well with all of our guests here. But continuing with a sense of the overall picture, Chanchal, let me also come to you on that, because would love to learn a little bit more about the process and taking off from where Nitesh left off.
So thanks, Abha. So well, investing in the small cap, the most important thing which we evaluate, and that bigger importance is given to the management quality. It's very important to back the right management and the right business. We have an internal process wherein we have a management scorecard, and we give various buckets where we define how management is on various buckets, right from the accounting policy to quality of disclosure to quality of board and the team, and the financial discipline and capital allocation. We have a set of a benchmark, and we evaluate all the management based on this benchmark. To define few things from this benchmark, accounting policy, the more conservative the accounting, the better it is. So to give you an example from a retail sector, if our management is more conservative in his accounting for the inventory, and if he follows a consistent policy, we give him a heads up. The other important point, when we invest in a small cap company, we talk to their entire stakeholder, be it the customer, be it the employee, or be it the supplier to them. We get and the competition. We get to know the in-depth analysis of the company from that perspective. As Philip Fisher has coined the word settle but investing, this helps us get into deeper on the company. The other important point where all the analysts focus on the earning growth, the underappreciated thing is the capital allocation. The most important thing, in fact, I would say the capital allocation. If you're generating a huge amount of cash flow, where are you allocating those cash flow? Are you investing in the right sector, or are you diversifying into the sector which is not complementing your sector? So capital allocation becomes a very important thing. The other learning which we have from last 4 or 5 years is when you are looking at the company, you should also look at promoter pledge and why is promoter raising money if he's raising money for other businesses which he has. I can give you example of a media company or of a pharma company or of a FMCG company where promoter pledge and raise money for different businesses. So it's very important to see promoter leverage and how this is allocating the money raised from the pledge. So these are important things we look for while evaluating a management.
Wonderful. Dhaval, investment is, of course, more about the process and following it with consistency. So tell us a little bit more about the process as well. We'd also love to hear from you.
So thank you, Abha. And I think Nitesh and Chanchal has covered few points really well. So maybe, first of all, very good evening to everybody. just to tell you on the outset, we follow an investment universe concept. And what do we mean by an investment universe, right? The investment universe at Aditya Birla Sun Life AMC, we have close to 380 companies, which is largely covered by the 10 analysts. Approximately 35-40 companies each, well covered. We have to focus on getting detailed financial model analysis. We discuss these companies, and not at any point in time that any particular company can be introduced in the universe. So there is a thorough process where a company is discussed, whether it's an IPO or a new ideation. The analyst role, right, doesn't end only at ideation or bringing the company in the universe, which thoroughly goes with discussion with the entire fund management team. But it goes, the real work begins there. Means we have to have a review process, which has been our discipline for now almost 8-9 years, where every Monday we have a portfolio managers meeting, and every fortnightly Monday we have evening analyst universe as well as analyst recommendation meeting. The point I'm trying to emphasize here is that these are the meetings which have been followed by now almost 9 years on a constant basis to just keep refining our investment process and keep analyzing the companies in a very detailed and consistent manner. And what goes without saying is that we keep meeting the companies very regularly. Once in a quarter, we follow up for every quarterly performance of the company or other corporate developments. And above all, COVID crisis has helped to get a consulting or a channel checks done across sectors, across companies really well. Means we can get into, without wasting time, get into any corner of the world these days to understand more about the companies we research. So that is the key crux on investment universe and the philosophy we have. I think in the previous 2 sessions, both Mahesh and other senior fund managers have mentioned, on a house basis, we've tried to follow GARP as an investment philosophy, which is growth at a reasonable price. Definitely multiple fund managers would have different styles, but this is our key view, how we manage our money.
Awesome. And it does sound like quite a detailed process, and one that you're constantly working on and evolving as well. Kunal, tell us, how the analyst team is managing the fund. I mean, I know we've already got a lot of perspective from Dhaval, Nitesh, and Chanchal, but, in terms of, again, the kind of process you're following, anything else that you'd like to add before we dive into the sectors that all of you individually track? Kunal, I think you're on mute.
Sorry, my bad. Yeah, thanks, Amar, for that question. So actually, from a managing the fund perspective, let me tell you, just before that, we went back and what we've, in terms of the, refocusing on all the companies, as Dhaval said, we have the whole investment universe. What we did is that, revisited all the companies across the investment universe, define the narrative. Now, in investment parlance, what is important is that, the narrative for a company should, is what it has to, well-defined narrative, basically tells the moat of the company and highlights the key strengths. The way we did is that, we bucketed all these companies into, 5 categories. One will be in terms of the fast growers. The second was in terms of the slow growers. In the third, in terms of the cyclicals. Fourth were, the kind of turnaround plays. And the fifth one in terms of the, high asset players. So that it helps us in terms of categorization. It helps us in terms of categorization of the company, define the moat of the company, and accordingly, we can construct the portfolio. So over the last, as Nitesh highlighted, so we, as the team, all 10 analysts, we've taken over, we've started managing slightly less than a year back. What we did is that, first is revisited, revamped in terms of the narrative for each of the company. Then obviously, with regards to, the changes that were required. So first 4 to 5 months, we just, changed the portfolio, reconstructed the portfolio. And then over the last 6 months, we've seen that all the efforts of all the joint efforts by all the analysts is getting to some extent starting to get reflect. The idea is that not to have a particular benchmark. It's about more giving specific allocation, get the best ideas in the portfolio from each of the analysts, and essentially it should be the high conviction idea which should getting reflected in the portfolio on an absolute. So the idea is that absolute return basis we should try and achieve this portfolio where basically we have a high absolute return stocks. And the approach is very much flexible in a way to accommodate more ideas if high absolute higher absolute return ideas are there. Probably you add that into the portfolio. So to conclude, I want to highlight one point to our investors and partners that there is a change the way we look at the whole small cap portfolio, and collectively we are working to make this a success, and it's a matter of time before we see the results.
Absolutely, I'm sure it is. And in fact, I wanted to ask all of you that because now you all track your individual sectors. So I'm curious to know, what really you feel is the opportunity for the next decade when it comes to some of the names that you're tracking, particularly in the small cap universe. So many times we get the argument that there aren't enough quality stocks in that universe. And I think that, however, on the other hand of this debate is the fact that that's really where the opportunity is for multifold growth, to find the next multi-bagger. So I'd love to get your views and maybe even pit you against each other to find out which sector you really feel is going to be the more exciting one. So Nitesh, should we start off with you and get a sense of the forward-looking outlook, the kind of subsectors within the small cap universe, perhaps where you feel the maximum opportunity is? I know that you also individually track certain sector funds, but we'll come to that later. But first, in a more general manner, some of the subsectors or niches that you are tracking.
Yeah. So thanks, Abha, for the question. I mean, before we go to the subsectors and the specific areas, I would like to summarize the views on the entire basket. I mean, the mid and small cap basket, which has been a very exciting for last 6 months. Effectively, if you look at the broader spectrum, ever since, even before the COVID crisis hit the markets in March of 2020, the entire mid and small cap were already in bear market. They peaked in December 2007, and the entire 2018, 2019, they were actually grinding down. As in the previous forum, some of the senior fund manager mentioned, there were multiple shocks and events which happened in India in last 4 years, right from Demon to GST to then ILFS crisis in 2018, and then finally the COVID crisis. The fact here is the companies which survived these shocks are now there, and they are the strongest of the lot. And therefore, I think they should stand to benefit over a long period of time. One more thing here, I would like to, add, in globally also, the small caps as a basket has started outperforming the large caps. So if you look at the Russell 2000 index in US, 6 month return of Russell 2000 index is 47%, versus 17% for S&P 500, the large cap index. Similarly, in India, the Nifty small cap index has outperformed Nifty over last 6 month period. And one more thing I want to mention, which is very, very interesting to know, that the entire 2020 has been broad-based rally. Okay, to give some numbers here, for example, in the BSE 200 index, in 2017, only 5 stocks accounted for 75% of the gains. In 2018, it was only 6 stocks which accounted for 75% of the gains of BSE 200 in that particular year. In 2020, that number became 25. So basically, it suggests that it has been a broad-based rally. And typically in an economic expansion, mid and small cap tend to outperform large caps, and they tend to do very well. One technical point I would like to highlight here, and which is very relevant and from a market angle, unlike in December 2007, we have absolutely no leverage in the system at this point in time. People are not greedy at this point in time. The positions are light, and we had a complete clean off in March 20 when the fall happened. So my sense is that as a category, as a basket, with such kind of structural setup, it is very hard to believe that the rally is going to be over in 6 months' time. I think there are some more legs to it.
Okay, fantastic. So lots of excitement up ahead for sure. Chanchal, let's talk about the consumer space specifically, and get a sense from you on what the opportunities are there. We've seen a lot of digital adoption, of course, across the board. Do you think that the offline versus online model will play out? So we'll start to see a lot more online players? Do you see that? Do you feel it's still undecided? What are the key trends that you feel will evolve in the space?
Thanks, Ava. So a lot of things have changed post the pandemic in the consumer space. If I were to highlight few things, one has realized how working out of home is very important and how home will play an important role. Most of us are taking this the entire panel from home. So the home will play a very important role. People invest in their home. So home improvement as a sector will play a very important role. If you look at consumer durable as a basket, the penetration of consumer durable in India is hardly 20%, 20-25%. So this is one space we are very bullish about. Next 10 years, next decade, you'll see a huge growth. In fact, 15% CAGR growth for next 10 years in the entire home improvement consumer durable space. That's one big bucket which came out of this pandemic and which will continue. The other big bucket is that people have realized the importance of health and hygiene. All of us have realized that how important it is to build your own immune system, to eat healthy food. People will move to organic and natural. People will look to reduce their sugar consumption. New categories will emerge. In this background, the MFD as a category will play a very important role. So that health and hygiene, whoever is able to play that category will be the winner in the next decade. The other important thing, Abha, is that when we normally eat out 5 to 6 times in a month, I'm talking about pre-pandemic, if not more, right? What people have realized that why not have food at home? Why not order online at home? So QSR will play a very important role. I'm talking about quick service restaurant. People will look to order food online and eat home at least once a month or not, if not twice a month. And the other thing people have started doing is a lot of car travel. People have moved to 500 kilometers, 800 kilometers by car. And when you're traveling by car, you are to stop somewhere, pick up a food and just move ahead. So QSR, as in India, car travel will develop. QSR as a space will develop. That's the third big bucket which I think will develop. And the fourth one, which you highlighted, people had said that Kirana as a channel has died down. Kirana is finished. Online and offline will play a role. But it's not about either or. It's about 1 + 1 + 1. So I think Kirana plus online plus offline, all three channels will play a very important role. Someone who is able to play a omni-channel, design a strategy, and play a mixture of all this channel will be the winner of tomorrow. So those are the 4 buckets I think will be the winner in the consumption space.
Okay, fantastic. Dhaval, on banking and finance, what is the positioning there? Do you feel that market share will shift between various lenders of the next decade? We're already starting to see a lot more consolidation. Then we've got all these key announcements coming in. On the PSU side, of course, NBFCs, we've seen consolidation. And it seems like with the economic recovery that's expected, this is a segment that's only going to grow.
So definitely there is always going to be a big buzz around financial services sector in our country. The sector was written off exactly 12 months back, or maybe post-COVID around March 2020, that there would be a lot of stress, loans which will get created. And ideally, you look at the last 1.5 months, people have realized that we have come out of COVID very, very well. Means versus many other economies as well, Indian financial services, especially the large banks, have done phenomenal when it comes to managing their asset quality despite the COVID crisis. Coming about positioning part, if one has to consider, we are very bullish on large private banks as well as maybe the large banks and large non-bank lenders as well. And it reflects in our portfolios. We have overweight positions across these stocks. The big picture story, if one has to understand, financial sector penetration in India is still far away from what the developed markets have or are, whether it is lending products, savings product, insurance products. So that story will never get over within the next decade also. The importance is that how and who are the players who are going to achieve or are able to crack or garner higher market share. If you look at the one big picture story is that per capita income, we are close to $2,000. Could possibly rise to $3,500, $4,000 over a period of next 7-8 years or over the next decade. This would lead to a big boost or a significant growth in the retail consumption loans. Chanchal just mentioned increased consumption. I'm just saying consumption has to be provided or financed as well. So that would be one part, and definitely mutual fund, insurance penetrations are still very far off from where the developed markets are. So all in all, a very good asset quality outlook versus expectations during March or May 2020 when we did last voyage has surprised, and therefore there has been a good rally in financial services in the last 3-4 months. I think it's still a big beginning from a long-term point of view. I mean, I'm fairly bullish, and that's what our portfolios reflect.
Fantastic. All right, Kunal, what about you for technology in the next decade? And this is one of the most exciting segments as well, given that everyone is jumping on the bandwagon right now and using it across multiple verticals. Do you see the industry back on a double-digit growth path? What's the scale of opportunity that you see when it comes to technology?
Yeah, certainly. I think, from a growth perspective, probably, the double-digit kind of a growth is possible for the next 2 to 3 years. What we've seen is that, there has, after almost like 6 years of a single, mid to high single-digit kind of a growth, we are seeing the revival in terms of the demand for the IT services companies, and particularly in the enterprise IT spending. What is driving is particularly, what is happening in the pandemic. Actually, we've realized that the kind of resilience that IT companies which service, all the global companies across the globe, they have seen that, even during this work from home, in terms of execution, they have managed to, execute and provide that resilience to their clients. And what has then happened is that the enterprise IT spending, there is a demand revival in core 3 areas. So three key trends in the space is with regards to modernizing the core infrastructure. Second is with regards to the adopting the public and the hybrid cloud. Third is the AI adoption and the omni-channel commerce, as Chanchal highlighted that certainly companies which had only one channel of commerce, essentially you need to have that omni-channel. So there is a lot of demand that is happening, and Indian IT companies, if you see, they have pivoted successfully to all these new technology spend areas. And their supply chains are quite efficient. As I highlighted, execution capability even during the tough lockdown period was very strong, right? And so after every crisis, so we've seen, in the past during Y2K, that was the first instance. Second instance was 2008 when the financial crisis hit. These tend to act as triggers for the sector from a growth perspective. So this last year's pandemic is certainly the third trigger, where after every crisis, we've seen opportunity for the sector and accelerated growth for the next 2 to 3 years. Be it, all the verticals are certainly increasing their technology spends, be it, banking, retail, manufacturing, manufacturing and telecom. All these are seeing increased tech investments, and hence from a growth perspective, we are quite positive and remain bullish on the sector.
Okay, Nitesh, coming back to you then, and to the point that I was exploring earlier about how small caps are also perceived to be more volatile or more risky. How do you allay investor fears on that front? And you created such a strong case a little earlier for the kind of opportunity over the next few years when it comes to the small cap universe. What else can really reassure investors when they're thinking about allocating money to the space versus a benchmark, for instance?
Yeah. So basically, I always maintain three key reasons that why mid and small cap throw opportunities. I'll explain these three reasons one by one. Number one, if you look at some of the high growth or the sunrise sectors, India being a developing country, our total market cap of India is like $2.7 trillion, and we have around 5,000 odd companies listed on the exchange. The US, on the other hand, is like $45 trillion, and the number of companies listed there are 20% lesser than what we have in India. So you can imagine the size difference that we and compared to a developed nation that exists today. So many of the smaller industry, sunrise industry, high growth industry, they tend to have these mid and small companies. They are catered by these mid and small companies. So if investors want to have the exposure in those sectors, the only way is to allocate money to the smaller mid-cap portfolios. For example, India's largest tile company is a small-cap company. The entire plastic processing sector in India is small-cap. The entire consumer durable manufacturing or the electronic goods manufacturing setup is either mid-cap or small-cap. PVC pipe companies, they were small-cap, migrated to mid-cap, now they are going towards large caps. So, there are huge number of companies and sectors which are there only in this particular space. This is point number one. Point number two is the information gap, which I call it. On an average, if you look at a large company in India is being tracked by 30 analysts, whereas in case of mid-cap, it is tracked by 15 analysts, and in case of a small cap, the number is even lower. So if you do a proper bottom-up job, and because of this information gap and less of tracking, the investment return could be superior. And the last and very important, again, a very technical point is the ownership structure of the mid and small companies. So I'll give you some data here. FIIs own 17% of large cap companies listed in India. The same percentage is 10% in case of mid cap companies, and it is just 4% in small cap companies. So definitely they are under-owned, and the money has not yet come in small cap, and perhaps in time to come, these things will change. So these are basically the three broad investment case why mid and small cap through opportunities.
Fantastic. I love how you've all sort of really shared some interesting facts and data with us, because I think that really builds a strong case, and it doesn't seem like just a whim, that go for a small cap because it happens to be cheaper. If you actually think they are cheaper, so let's also come to that as well. Chanchal, when it comes to valuations, your sector, that's one where they're always very pricey. So, do you see the valuations continuing at these levels? How do they stack up? Again, what's the case really for buying in? Definitely, I mean, if one can't, buy into some of the more premium names in the sector, but want to kind of invest, in the consumer story, then one would have to sort of take a look at some of the small cap and mid cap companies.
Thanks, Abha. Pricey, you called it out. Quality comes at a price. Let me start with that. So quality comes at a price. If you look at Indian demographic, I mean, the easiest said 130 crore people, more than 50% below 35 years of age. We've just started consuming. Dhaval was mentioning per capita income, we've just crossed $2,000. Look at the tailwind which we have. The demographic is in our side. Per capita income will improve. The GDP growth will come back. Consumers will spend. They will leverage and spend. Banking is here to help them leverage and spend. And that's the reason people are just looking at good quality management and good quality consumer story to buy. One thing interesting which we have learned over the last 10-15 years is that the price is a slave of earning. If the earning growth keeps coming in this sector, the price will eventually follow. I can't define a 30p or a 40p or a 50p is good, but I can assure you that the earnings growth in this sector for next decade can be a decent 13 to 15% compounding if you're able to pick up the right story and the right sector where the growth is going to come. To give you a few examples, I mean, retail is $800 billion market. We don't have any company more than $5 billion of sales. Look at the opportunity size in retail. When people built up their retail businesses, both online and offline, what can that be in a decade from now? So obviously the stock here will be expensive. Quality comes at a price. The reason of also being expensive is that these are good cash flow throwing companies. If you look at the amount of free cash flow they generate and the amount of money they are able to reward to the shareholder is humongous. And also the company, if you look at, has shown a history and pedigree of good management, good growth over longer term, and that's the reason the valuation is at what it is today.
Okay, I think that gives me a good segue into, into kind of talking, when you're talking about technology and so forth, also getting Kunal in on this, because, Kunal, let's talk about the structural differentiators between, the global peers and the Indian peers when it comes to technology. And, what are some of the key differentiators that you see there, particularly at a time like this when everyone's looking at technology very closely?
So when we look at Indian IT sector and compare that to the global peers, one of the key indicators over the last 2 to 3 years that is starting to emerge out is that the large pool of digitally trained headcount. So companies have invested in the training, and most of their employees are now trained in the new generation digital technologies. And that is essentially helping, at this point in time to emerge as a key differentiator. Second is with regards to the execution and the project management capability Indian IT, basically they have been able to gain share year after year. And in terms of opportunity, if you look at over the last, last decade, what is happening is that every time Indian IT, exports currently at about $150 billion. But if you look at the addressable market, the total IT spend continues to be is about $1.2 to $1.3 trillion. So we are still, many times in the past also written off. The sector was written off, right? That it's a low single-digit growth kind of a story. But every time we've seen that through the crisis, the sector has really come back, and that is essentially the execution and the resilience that the companies have shown, retailing, and year after year they've gained the market share. I think that is something that is quite a differentiator. And the third is with regards to when you compare the cost at which the kind of services have been provided, that continues to be almost like 40% of the global, or lower than 40% of the global cost. So that arbitrage still continues, and it is likely to continue in the future as well.
Okay. If I were to just go into, Dhaval already knows I'm going to ask him next. He's smiling. But if I was to go into financials, and again using the example, what we're seeing globally, what we're seeing in India, valuations have been under pressure with fintech, with new, tech platforms, new kind of payment companies as well. Even here in India, lots of competition coming in from tech giants and payment companies, fintechs and so forth. So how do you see the space really evolving then, Dhaval, over the next few years, or even over the next decade if we were to see? But what's the longer term outlook? Would you now start to choose stocks a little differently, keeping that in mind?
Definitely stock choosing or selection of stock is a different subject, but just to give you a market perspective, your question is pertaining to fintechs versus banks, or maybe comparing what is happening in China, where fintechs have emerged very strong, US, the fintechs have emerged fairly stronger, or they've got a big market caps as well, and where does India go, right? So if you look at India's large banks, right, all the large private banks, even SBI, if one has to look at, they are market leaders when it comes to consumer lending or retail financing. Especially most of them have done very well when it comes to the top cities in the country or tier 1 cities when it comes to getting the lending penetration. So a big proportion of under penetration in the country is largely in semi-urban and rural markets. Fintechs today, if they have to make money and not spend money, they will have to lend money to people who are not getting easy money from banks, or they are not able to borrow from banks, and they'll have to go to higher risk category. So they are actually expanding market and not competing with banks. So that is a big point, number one. Now you look at what is banks and how are they operated, right? So they come with a very big regulatory moat. One, they have an access to low cost deposits or time deposits, term deposits, what we call, which none of the other companies would have at this juncture because of the regulatory reasons, or basically banking license. So they have a very strong liability franchise. You look at last 10 years, other than COVID crisis, retail NPLs have been very low. We have a very strong underwriting practice by most of the large private banks, and including even SBI, if one has to consider in the public sector space. Even the larger NBFCs, the likes of Bajaj Finance and others, they have demonstrated a stupendous retail asset quality over the last decade. So the point is, again, you will have to showcase the same underwriting capabilities if you have to compete with these large lenders. Then the third most important point is they right now already own the customers. So from here on, you first have to compete on regulatory aspect, which is not easy. You will have to have your own customer, whereas I mentioned is only going to be on the underpenetrated and more risky segments, which would be tier 3 to rural centers. And you will have to constantly innovate. For banks, the bigger picture is whoever continues to invest on digital capabilities. And today, what I understand after the last 5 years of emergence of the likes of Paytm, Amazon, and many other tech giants in the financial services business, the outlook or the approach will be more collaborative. They don't want to fight with each other because the market is fairly large, unlike other geographies. So maybe collaborative approach, there could be some profit share between the two, but the under-penetration will lead to very high profit growth, if not higher return ratios versus what the last decade showed. So in simple words, if I have to borrow from Mr. Aditya Puri's one of the interviews, he very clearly said that banks cannot be replaced by the big tech or fintech companies because they do not understand regulations and they neither know how to deal with the regulators. And most of these banks, which I am talking about, the larger ones, are very well ranked with regulators in terms of following rules and innovating as well. So that's the big picture. I think the next decade continues to be difficult and challenging, but ultimately the large banks will continue to remain relevant, and they will strive. They will actually thrive forward.
All right. Nitesh, what about cement, metals, particularly with the government's focus on infrastructure?
Yeah, so basically cement, infrastructure, and anything and everything related to capital spending should do really well. And you asked me previously, like, what are the subsectors which should ideally do well in coming years? I would like to club the question along with it. In the sense, we are actually super bullish on the entire manufacturing setup, because the way India created in 90s, we created the IT industry in the decade of 2000 to 2010. It was auto and pharma. I think for the next decade, with the kind of focus that this government has on the manufacturing side, the next decade is going to be manufacturing this thing, because the share of manufacturing in India's GDP has been quite stagnant for last few years. And with the PLI scheme in place, there are like 12, 13 sectors where the government is focusing to propel the manufacturing. Just to give you brief mathematics, the government want to give incentive of around 2 lakh crore at the rate of 5%. So basically, if the scheme is successful and execution is proper, this alone could generate around 40 lakhs crore worth of manufacturing revenue in next 5 years. So that's the kind of opportunity we are looking at. So definitely some of the sectors included there, be it electronic manufacturing, API in pharma, technical textile, special steel, auto ancillary, and there are like host of other companies, other sectors which are included in PLI. This is on part one. And on the infrastructure side, definitely this budget had showed that the fiscal stimulus is there and the infra sector should do well. Cement in particular, we at the Aditya Birla Mutual Fund have been super bullish for last few years, and it is actually reflected in our positioning versus the benchmark weights. The reason being, cement offer the cleanest play on India's infra story. All the companies are net cash balance sheet companies, high quality management, and a structural growth industry. One fact is that 70% of India's cement capacity is owned by 5 large groups. So that kind of concentration we have. And hopefully in the coming years, along with the housing revival and the real estate revival, plus thrust on infra, cement should continue to do well.
All right. Kunal, on the IT segment as well, given the kind of outperformance we've seen in IT over the last 3 years, what are the kind of return expectations that one should have? And I think there are a couple of questions also coming in on the kind of scope of investment there.
So from a, let me address the second question first with regards to the scope of investment. So IT in India, technology, essentially we've so far been able to invest in the space on the IT services side in particular. And essentially, that has been a story that technology spends globally. What's important is that, over the next coming decade, I see that the investment scope in the technology sector is going to widen. We'll have, so last couple of years, if you see, there has been, companies who have been domestically focused, who are in the internet slash, platform play. Okay, and they've done really well. Looking at the success, we do see that, there will be more companies who are go public, be it in the, large, so media reports do tell us about, large food tech, insurance kind of companies are planning to go big. So, while the proposition of the IT services will continue to be, solid, but I think investors will get opportunity as new companies come and, the whole digital India, right? What we've been talking about, that there has been a digital wave in India and the whole transformation is happening. So we'll see, domestic focused technology companies also coming in, having investors getting that opportunity. From an investment, so from a first question perspective, so obviously, IT sector last 3 years compared to the market, it has done very well. So the obvious question is that, what from here, given the valuation re-ratings that has happened. My view is that given the kind of growth outlook, the kind of valuations that are there, so sector trades at almost like a 24, 25 forward PE. I think, that should likely sustain because the growth outlook is fairly positive. Second important point is that these are fantastic, cash flow companies, and last 3 to 4 years, we've seen that, tier 1 companies, they've been paying almost like 80 to 100% of their payouts, as in net profits as payouts, either in form of dividends or in form of buyback. So, I continue to believe that, double digit or early double digit to mid double digit kind of a return expectation is fair. Probably near term it could consolidate as we see domestic cyclical recovery that is happening. But certainly, year after year, we've seen that the kind of resilience that tech companies, because of the cash flow and the steady growth, that should continue.
Okay. So we've just got a few minutes left to go, so I'll just take closing comments from you guys. And Nitesh, let me start off with you. Just to kind of sum up some of the opportunity that you've described in great detail, actually. But just in terms of the fact that there are key processes that are followed that help you really go out there and find these gems that you do see an opportunity, as you've outlined with so many of those facts for not just the near term but the longer term, despite the recent run up that we've also seen in the overall market. And anything else that you'd like to leave us with today?
Yeah, so essentially the summary of the discussion, I would like to make a final comment is that there are opportunities in mid and small cap, even though they tend to be a little volatile, but over a long period of time, if you do the job consistently, I think they create, tremendous alpha over other large cap or other equity instruments. One thing I would like to make about our Aditya Birla Sun Life small cap fund is that we are absolutely true to the level. We have 75% of our total fund in pure small caps, and the balance 25% in mid cap, and hardly 1 or 2% in large caps. I think the small cap proportion of 75% is among highest within the industry, and therefore we can proudly say that we are truly running a small cap fund in a right fashion and right way. Yeah, thank you very much.
Actually, that's great. I'm glad you mentioned that as well, because these differentiating factors make all the difference. Chanchal, when it comes to, of course, with the consumer space as well, valuations will always, of course, continue to be a question mark. But outside of that, and we discussed that in detail, we've seen the impact the pandemic has had on the sector as well, with certain segments doing better than others. But anything that you would like to share with us as we wind up?
No, thanks, Abha. So you have summed it up well. The only point is that some companies will be able to adopt themselves digitally. Post-COVID, the digital adoption will play a very important role. So companies will be able to adopt themselves digitally, will be the winner in this next decade. You have to watch out for what are the changes happening and which are the companies and how are they adopting. One thought which I had in mind when Kunal was talking about digital is that when companies are talking about precision marketing, that we have heard word of big data and how companies are analyzing. So companies are analyzing where Abha is shopping, what she's shopping, what she's eating, and they'll be able to market you based on those data. So that's the in-depth work which is, and they'll be able to help you premiumize next time you're buying the same article. So companies who are able to analyze this big data, use that data as a means to premiumize the customer, sell right into the customer, will be the winner over the next decade. We'll keep an active watch on it and we'll find the winners, have it in our portfolio.
Fantastic. Double banking and finance, and that's going to be an interesting one because criteria is going to change. It's already changed, with so many regulations coming into play and everyone being a lot more careful. How do you see things evolving?
Sorry, I was on mute. I mean, things keep evolving, keep changing, and being an economic linked sector, we have the economic volatility continuing in the sector. Definitely things are not in the same manner to analyze or select. You would ask this question, I didn't answer it clearly maybe. From here on, if I have to look at stock selection or how do we look at the markets and small cap as well as in general stock ideas, we'll have to now focus on companies which will be proxies to some growth avenues within the economy. Now, whether it is digital space, fintech lending space, payment space, though payment sector has not made enough money, but even that is a customer acquisition tool. How do you then monetize that acquisition of customers you've done over the years? Focus on evolving business model. One important stuff which would be very important to know is whoever invests very well in technology, digital capabilities would gain a lot. I just want to give you one simple example. Maybe a lot of people would be able to relate to. Early 2000s, when all these current large private banks were started in 95 to 2000 era, they brought in core banking solution. Now today, in such a digital environment and technology environment, core banking solution is old technology, but that was something which led to a sea change for these banks, differentiated that. Again, public sector banks also implemented the same thing and everybody benefited out of it. Same could be the fintech angle across, whether it is insurance sector, technology, disruption, lending, deposits. I think the same could be for the entire financial services or maybe many other sectors, as Chanchal was talking. So this is how one will have to look at perspective about the size or the scale the company can achieve. And the third big picture here is we'll have to look at the companies from the global perspective when you look at valuations. So when we mentioned GAP, right, Nitesh was talking about Russell Index, Chanchal was talking about the penetration of his companies in terms of size of the market they have achieved even now versus the demography. I would like to conclude here is that we'll have to look at valuations of all our big or small companies, not just on the price to earning or whatever respective ratios, but also from a global perspective where they stand. And therefore, it makes a lot of sense to look at small cap space. The last example is Bajaj Finance, a stock or an HDFC Bank stock, right? It began in some small cap portfolios years before. In fact, Bajaj Finance, the first time we invested as a house, we've already seen, and we are still, all of the schemes are largely holding, and we've seen close to 45 times return in the last 7-8 years. So that is the possibility, realms of the possibility of ideation which comes from small cap fund. So I reiterate what Nitesh mentioned, and because 10 brains are working behind that. So this is the most bigger differentiation factor versus the market and the other fund houses. So that's it.
Wonderful. Gentlemen, thank you so much for sharing that with us and for coming together today to really give us an in-depth look at really what goes on behind the small cap fund. That was very meaningful. Thank you.
Thank you.
Thank you.
Fantastic. Thank you so much, Abha, for that. And thank you to Nitesh, Dhaval, Kunal and Chanchal for those great viewpoints, those great detailed analysis of what you guys do. I mean, we invest in your funds throughout the year, but it's always a pleasure on the Voyage platform to find out more about how you invest our money, and especially getting to know a little bit more about the Aditya Birla Sun Life Small Cap Fund, because yes, it's really an important space for people who want to have exposure to small caps, and it's good to know how the team works towards investing there. All right, now the other important thing, is that whatever a person's viewpoint is, and again, it depends whether they're risk averse or they want to take more risk, but whatever their viewpoint is about the markets or whichever sectors they favor, the most important thing is to stay invested and not get greedy or panic and redeem the investments. Here's an example why haste does really make waste. Take a look.
Hi Mr. Verma, congrats on your new car. You worked overtime, saved long and bought your dream car. But what's that? Oh hi Mr. Lohia, your retirement home is free from pollution and hustle bustle of city. But where's the roof? Okay, we are exaggerating a bit, but Mr. Verma is not exactly in the car he dreamed of. And Mr. Lohia is retired comfortably, but in a nice flat and not his dream bungalow. But why did this happen? Who spoiled their dreams? Maybe greed, maybe fear, but surely could be redemption driven by greed and fear. How? Let's look where Mr. Verma's luxury car became a small car. For illustration, this is the market in Jan 2014. Mr. Verma started an SIP of 15,000 rupees in the Nifty 50 for his dream car. The market rallied, and in March 2015, Mr. Verma got just a wee bit greedy and redeemed 2 lakh rupees profit to upgrade his furniture and buy a new phone. As a result, his final corpus in Jan 2018 was rupees 6,99,663. If he had not redeemed 2 lakh rupees, then it would be rupees 9,56,362. That redemption is the difference between a dream and current car. Did Mr. Lohia lose his dream bungalow to the same thing? Well, a little different. In the year 2000, he started saving for his retirement home. He started an SIP of 10,000 rupees. He was to retire in December 2019, but in Feb 2009, he had accumulated a corpus of 19.2 lakh rupees and got scared of the market correction. The global financial crisis came and Mr. Lohia panicked. He stopped his SIP, redeemed the investment and put it in a traditional investment option that gave him approximately 7% returns. Hence, his final corpus was 58.5 lakhs. If he had stayed invested and continued his SIP, he would have had rupees 1.2 crores in corpus, more than 2 times. He actually missed the 8th wonder of the world, that is, the power of compounding. Do you see Mr. Lohia's and Mr. Verma's story play out in 2020 with the crazy market fall in March and rise till November? Did you get a little scared in March and redeemed or stopped your SIP? Or are you looking to redeem now that you may see some of your investments in green? Beware, Mr. Redemption can dent all your goals and dreams and make a bigger impact if your goals are long-term. Big dreams need clear focus and time. Don't let dream killer Mr. Redemption impact your goals. Aim to stay invested in your dreams. You can redeem only on advice of your advisor for rebalancing or if there's a pressing emergency. Else, aim to stay invested in your goals. An investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Exactly. Aim to stay invested. That is the most important thing. All right, now this next speaker is one that I've been eagerly waiting to listen to. We've all heard of Albert Einstein, and I'm sure most of us have quoted him at some point of time. You know, the part where he said, compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. Kind of the theme behind our champion of the 8th wonder contest earlier today as well. Now, our next speaker is someone who understands the power of compounding very well. In fact, he's written a book about it too. And today he's here to talk to us about how compounding is the propeller for long-term wealth creation. Please welcome portfolio manager and author of the book, The Joys of Compounding, Gautam Baid, and he'll be in conversation with ET Now's Ajay Sharma.
So, all right, ladies and gentlemen, all the viewers out there, this is a special interaction which we have planned for all the attendees of Aditya Birla Voyage 2021. Remember, this is the most marquee platform where we bring for all our viewers and partners of Aditya Birla Mutual Fund some of the best names in their fields, top thinkers, and when we ideate every year from this platform on how things are likely to pan out in the world, in various fields, or even in the area of investing. Remember, this has been a very difficult year and a very strange and surprising year for many reasons. First, the unfortunate advent of COVID, and then the speed at which we humans really cope with it and rebound. In fact, equally sharp was the market rebound, India as well as globally. The surge of even the retail investors, which this time around even bought the dip to a certain extent. And of course, the numbers are increasing with each passing day. Today, we have someone who is not only a professional money manager, but more than that, actually a world-acclaimed, globally acclaimed author and a very passionate value investor. And our dear friend, Gautam Baid, is joining us today. Of course, his book, Joys of Compounding, is something which is making waves globally, not only in India. And Gautam is a dear friend who is joining us today to help our viewers
and all the participants and partners of Aditya Birla Mutual Fund, how one should become a better investor. This phenomenon of compounding your wealth over the long term, he's done some really great research. He's an ardent follower of Mr. Munger and Mr. Buffett. And today he will really cull out some gems from his research work. I call it a research work. It's a great book, which has got a lot of followers, to help everybody attending this session not to be jittery in the market, and how to be a successful investor, have only long-term horizon and picture as an edge in mind, and not to have action bias, not to mix activity with progress. So I will not come between you and Gautam, all our viewers. Gautam, it's a wonderful, such a pleasure to be chatting with you today. Please go ahead and start your presentation.
Thank you for the kind introduction, Ajay. It is great to be with you on this year's edition of Voyage. Please note that the views expressed in this presentation reflect my personal analysis and opinion, and not that of my employer firm. Please do your due diligence and consult your advisor before acting on this analysis. I would like to begin with a brief discussion on the essence of compounding. Albert Einstein had defined compound interest as the eighth wonder of the world. He who understands it earns it, and he who does not understand it pays it. This is how compounding looks like in real life. Self-improvement is the ultimate form of investing in oneself. It requires devoting time, money, attention, and hard effort now for a payoff later, sometimes in the far distant future. A lot of people are unwilling to make this trade-off because they crave instant gratification and desire instant results. These short-term costs, when applied the right way along with access of time, offer an exponential payoff when applied over a long life. That is how you get to experience the J-curve effect as shown in this particular graph. But before that, most people have to undergo and experience what is known as the valley of disappointment. It's because in the initial years, in spite of putting in a lot of hard work and effort, they have little tangible or concrete results to show for all that they do. Never give up after putting in the hard work and effort, because compounding bestows its benefits on you only after a long time, after testing your patience and conviction to the fullest. This is true not only in business and investing, but also in life and relationships. So how does one develop the tenacity and the resilience to get through this initial tough and challenging phase? You do that by finding your North Star. When you find your North Star, that is the most important thing that sets your life's course. You finally learn where you're headed. And that is such a good feeling. It is fine for your North Star to change over time, but whatever it is right now, let it guide you. Your North Star is highly meaningful and vital in your personal context. So aiming towards this beacon of light will bring great happiness to you every day. Former world heavyweight boxer Ed Latimore once tweeted, "When you can use your skills to make a difference in someone's life and get paid for it, that's the happy life. When you're passionate about it as well, that's a calling. The feeling is almost divine." And how does one get to experience this divine feeling? By discovering your ikigai. Ikigai is a Japanese concept meaning a reason for being, and it refers to the convergence of four primary elements: what you love, your passion, what the world needs, your mission, what you're good at, your vocation, and what you can get paid for, your profession. I've talked about various aspects of compounding in my book, including compounding positive thoughts, compounding good health, compounding good habits, compounding knowledge, compounding goodwill. Today, I will specifically talk about compounding wealth. The key to compounding is time and endurance. Morgan Housel very aptly wrote that good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that kill your confidence when they end. It's about earning pretty good returns that you can stick with for a long period of time. That's when compounding runs wild. In a similar vein, Warren Buffett once wrote that the first thing to realize is that it takes a long time. I started when I was 11. Accumulating money is a little like having a snowball going downhill. It's important to have a very long hill. I've had a 56-year hill. It's important to work in sticky snow, and you need a little snowball to start with, which I got from delivering the post actually. It's better if you are not in too much of a hurry and keep doing sound things. Now here, I would like to mention that the investor community in India's domestic mutual fund industry have not been doing sound things recently. Since July 2020, we have had 6 straight months of outflows from domestic equity mutual funds, including an outflow of almost 13,000 crores in November 2020 and more than 10,000 crores in December 2020. What is the reason behind such behavior from these investors? MS Venkatesh, CEO at AMC, recently remarked that outflows from equity-linked funds have continued because markets are at all-time highs and investors are booking profits and choosing to stay on the sidelines. Another market commentator, Kirtan Shah, remarked that a lot of people have been calling us to book profit. Retail investors are pulling out money. A lot of them are getting out because after seeing such a dramatic fall, they are now seeing some money come back. And they are unsure whether these levels are sustainable. They're probably worried that there will be a big fall. What financial advisors really need to do is educate their clients and customers that downside volatility in the stock market is frequent and as normal as day following night and night following day. Look at this particular chart showing the maximum intra-year drawdown in the Nifty since 1991, the era of liberalization. We have had drawdowns ranging from 60% in 2008, 46% in 1992, 40% in 2001, and most recently, in last year, we had a drawdown of 38%. But did all this interim sharp downside volatility make any difference to the long-term business performance of the wealth creators? No. Because investing is all about identifying great businesses with high quality earnings growth and capital allocation and firmly holding on to them as long as they exhibit these characteristics. The stock markets do not really matter over the long run when you invest in such businesses, and most important, stay the course. Let me illustrate this with the help of the example on the slide. If an investor had invested in a basket of good to great businesses near the peak of the previous bull market in January 2008 and held on to near the end of the subsequent bear market in 2013, he would have created a lot of wealth for himself. But if the same investor had invested in a basket of bad or gruesome businesses, then he would have lost a lot of wealth. The key message here is that great businesses create wealth across market cycles, irrespective of negative macro headlines like high interest rates, rising inflation, geopolitical tension, political uncertainty, and weak macroeconomic data points. Gruesome businesses eventually destroy wealth, irrespective of whether the headlines are positive or negative. It is a futile attempt to try to time the market and try to hop in and out to eke out that extra big bit of return. Howard Marks, in his memo to Oaktree clients in February 1993, said that the average annual return on equities from 1926 to 1987 was 9.44%. But if you had gone to cash and missed the best 50 of those 744 months, you would have missed all of the return. This tells me that attempts at market timing are a source of risk, not protection. Investors need to bear the periodic bouts of downside volatility as the price to be paid for earning superior returns from equities. Time in the market matters, not timing the market. The ability to keep investing at regular intervals, to stay the course through thick and thin, ups and downs, and bull markets and bear markets, and to not worry where the markets are going tomorrow or next week or next month is what matters. According to a study done by Sage One Investment Advisors, even though the Sensex went up 251 times between 1979 and 2017, if you missed just 7% of the best months or 1% of the best days, your returns would have been zero. So what is the big message that we take away from all this? It is to stay the course and maintain the faith in equities as a long-term wealth creating asset class. I've talked about the same in my book as well, that compounding is a lifelong journey, and an individual's impatience with his or her investment process could lead to a fatal decision and bring the journey to an abrupt end. Stay the course and remain faithful to your personal investment philosophy and your individual process. Focus is the key to success. Low and negative return years are a routine part of the investing game. You have to be present in this game for a long time to win. The key is to avoid getting thrown out midway because of reckless decisions. If we continue to earn above average returns over long periods of time and avoid permanent loss of capital in bear markets, the magic of long-term compounding ultimately will take care of the outcome. What is this magic of long-term compounding referring to here? And how can it help us achieve financial independence? In his famous November 2018 talk, veteran Dallas Street investor Ramesh Damani talked about the incredible power of compounding. In that talk, he referred to the rule of 72, which I've talked about in my book as well. And I quote, according to the rule of 72, we double our capital every 3 years by compounding at 26%, 10 times in 10 years, and 100 times in 20 years. Once you have achieved financial independence, it is important to realign your portfolio to have the majority weight in high quality businesses. After reaching a state of financial prosperity in life, ensure that you take all necessary steps to avoid being thrown back to the starting position. Achieving success and then losing everything has a far greater emotional impact than failing before ever having achieved success. Time is power in investing. Let me illustrate this with the help of an example from my book. Paul is 18 years old. He gets an after-school job and opens a Roth IRA or a savings account in which he saves $5,000 per year and continues doing this till he turns 70 years old. Paul is a know-nothing investor, invests in cheap, low-cost index funds, dollar-cost averages, reinvests his dividends, and earns the same nominal return that the US market has earned for the last century, which is around 10%. As a result, Paul ends up with a little more than $7 million in wealth. Paul's friend Peter is also 18 years old. He also gets an after-school job, but he doesn't save anything as he wants to engage in instant gratification and conspicuous consumption during his fun years. Peter waits till he's 30 years old, at which point he opens a retirement account, saves $5,000 per year in it, and then does all the same things as Paul. Now note, at this particular point of time, Peter is only $60,000 in total contributions behind Paul, and he still has 40 years ahead of him. So he figures it isn't too bad. When Peter reaches retirement though, he has only $2.2 million with him. So as you can see, maybe $60,000 difference between Paul and Peter in cumulative investment turned into a $4.8 million difference in net worth. This example shows, as John Bogle would call it, the relentless rules of humble arithmetic. There is a mathematical equation for wealth creation, and it goes like this. Add to your savings every month, subtract and eliminate biases, greed, and wasteful expenses, like taxes, brokerage, and statutory charges. Multiply your time horizon. Divide across asset classes as appropriate for your stage in life and your personal circumstances, and achieve the exponential power of compounding. The way to wealth is to buy right and hold on. By doing so, an investor minimizes paperwork, transaction costs, and capital gains taxes. To reap genuine riches, one needs to invest in long-term winners and hold on for compounded tax-free growth. No more effective tax haven exists than unrealized appreciation in a long-lived, soundly growing company. Compounding combined with patience is an incredible force over time. In the course of our daily lives, we treat a 2% charge as a small amount. In the world of investing, however, 2% is a huge deal. It has the potential to change your life completely. Benjamin Franklin very aptly said, "Beware of little expenses. A small leak will sink a great ship." To illustrate the huge impact a tiny 2% of savings in frictional costs can make in the long run, let's assume that you invest $30,000 today for 40 years in 3 fixed income instruments yielding 7%, 9%, and 11% respectively. At 7%, you would end up with $0.4 million in wealth. At 9%, you will end up with $0.9 million. And at 11%, you will end up with $2 million. And now it is the turn of equities, the greatest long-term wealth creating asset class. This graph shows what would happen if you invested the same $30,000 in a portfolio of high quality stocks with 15% earnings growth and 2% dividend for a total of 17% return. In this case, you would end up with more than $16 million in final net worth. This is compounding wealth in action, and it shows the incredible wealth creation potential of equities in the long run. And mind you, in our example, we assume that you did not make even a single additional contribution throughout your earning years. Just imagine how your compounding engine will skyrocket once you make regular contributions too. The final figure then becomes truly astonishing. The effects of compounding are too small to be noticed until they are too large to be ignored. Instead of treating dividends as free money and engaging in mental accounting, investors should resist instant gratification and always reinvest their dividends. Reinvesting your dividends through a dividend reinvestment plan is a great way to take maximum advantage of the power of long-term compounding. A dividend reinvestment plan automatically uses your dividends to buy more shares of the holdings in your portfolio. You should enroll for the dividend reinvestment option. You gain the benefit of dollar cost averaging, and after enough years go by, the benefits accrue in the form of higher dividends that may be a multiple of the original investment. This is the power of compound interest. In addition to earning returns on the money you invest, you also earn returns on those returns over time. This compound growth is what causes your wealth to snowball over time. When we reinvest dividends, we enjoy the power of double compounding or compound interest on steroids. I would like to conclude with a key message from my book that the goals of investment should be happiness, joy, growth, intellectual satisfaction, and eventually peace and serenity. Wealth and financial prosperity are natural byproducts of lifelong learning. For any feedback or queries, feel free to connect with me on thejoysofcompounding.com. I can also be reached on LinkedIn and Twitter. With that, I come to the end of my presentation, Ajay. Thank you.
Thank you very much, Gautam, for that insightful presentation at Voyage 2021. It's amazing to have you, and our viewers and participants would have benefited a lot from the insights which you painstakingly put together in the book Joys of Compounding. I have some queries. I've actually, as they say, the best way of grasping a book is to rereading it, and I have reread your book and really enjoyed it better than the first time. Some queries on behalf of some of my friends out there who are listening to you and from myself. There are times in the market when the market really tests the durability of your portfolio and the strength of your conviction. Many of our friends and us as well went through that time in 2020, be it March, April, May, June period, that should I liquidate everything and turn to cash and feel safe? Or even now, all the way from October, November to now, when the feeling is that the market is at all-time high, my portfolio is doing well, should I book profit? All this kind of a jitteriness in our mind which comes, and what are your thoughts? What kind of research, insights can you share from your book and from your experience on how to have a strong, durable portfolio and build a even stronger conviction around it?
That's a very good question, Ajay. Investors can be best prepared to survive the inevitable periodic severe corrections in bear markets during their lifetime by ensuring that they have tennis balls or high quality businesses and not bad quality junk stocks or eggs which splatter after hitting the floor. In a market crash, both quality and junk fall, quality eventually rises again, and junk never recovers. Many individuals make large paper fortunes in a bull market but lose all of it when the bear market eventually arrives. How much you are able to recover after the market recovery from a bear market is far more important than how much paper profit you make in a bull market. And quality of the business matters the most in retaining long-term wealth. Now, at this stage, I would again like to re-emphasize that after reaching a state of financial independence, it is very important to realign your portfolio to have the majority weight in high-quality businesses. And the key to a lifetime of investment success is not to make brilliant or complex decisions. It is to avoid doing foolish things. After reaching a state of financial prosperity in life, ensure that you take all steps to avoid being thrown back to the starting position. Always keep in mind that quality of the business and integrity of the management matter the most in creating and more important in retaining the hard and long-term wealth.
Gautam, you also mentioned in your book the importance of associating yourself from the right kind of people in the field of investing, perhaps more mature and wiser, and who have spent more time through the cycles, so that one can learn and compounding knowledge of sorts. If I were to just take it a step further, for a lot of our mutual fund investors watching this, to seek regular counsel of your investment manager or planner as well. What is the importance of that? To be regularly having a sounding board in this entire lifelong game of investing, as they say.
Yes, Ajay, it's a very, very important life lesson that the more you reach out to and associate with people who are better and smarter than you, the more you will learn and the faster you will improve. If you are the smartest person in the room, then you are in the wrong room. It is wiser to be with better people and feel uncomfortable than to restrict yourself to a mediocre circle just to feel comfortable. For example, if it were not for the generous help and guidance of my investor friends and colleagues, then my personal portfolio would never have been able to hold up as well as it did during the bear market in India from January 2018 to March 2020. I hope to always keep learning from them. just like I did last year in 2020, when I got to learn about investing in differential voting rights, warrants, and partly paid shares for the first time in my investing career. And all of them turned out to be highly profitable. The key message here is that the people closest to you play an outsized role in your level of success or failure. So choose wisely. You are, after all, the average of the 5 people you spend the most of your time in life.
Right. Gautam, but let's take a leaf out of your personal experience. I will not discuss your portfolio, but I'm curious and I want to know how was your own investing experience in 2020? It was one of its kind event not seen in 100 years. How did you go about navigating through? And also the question which is appearing in many minds right now, what do I do? Markets are so elevated. That kind of nervousness. What are your thoughts?
Well, let me share my biggest learning from 2020 first, that it simply reinforced what I've learned over the years, that devastating events can occur in the markets at any time, and they will happen again without any warning. Don't set boundaries that might limit what the market might do. You should expect the unexpected in this business, expect the extreme. And one of the biggest realizations I've had over the years is that the unexpected and seemingly impossible continue to happen frequently. This is why reading history and studying human behavior during past episodes of panic and euphoria in the markets is so valuable for an investor. Voltaire rightly said, history never repeats itself. Man always does. And just to describe about my own experience last year, and where am I finding opportunities right now? So just like I said earlier, just remain invested because time in the market with great businesses matter. If you just zoom out and take a long-term view, then all these big crashes just look like blips in the long-term chart of equity returns in India over the last 30 years. So just it's important to stay the course. That's really the biggest lesson. And one more big lesson which I've learned over the years is that there is always a bull market which is going on at all times in the stock market in some specific sectors. If you ask me right now, where am I finding opportunities in the Indian market? I can name many of them. For example, consumer electronics, manufacturing outsourcing, CDMO, CMO, animal healthcare, cloud computing, building materials, auto ancillaries and import substitution plays which have completed large capex. Those are some of the very promising thematic opportunities present in the market right now.
I'd like to take a step back towards temperament and behavior because that actually influences a large part of your returns which you make in your lifetime. Because Gautam, I know you have conducted very deep research while putting this work together, which is the book Joy of Compounding, and in daily life too, being a research-oriented person. What are the biases which impact investors, and it may impact early investors or even established investors many times? Some of the big biases which one should be conscious of that they don't develop in our own mind, like action bias. That feeling that constantly if I'm doing something, it means it's a positive and we are progressing, or any other which you have observed which people should stay away from.
Sure. So one of the biases you have already mentioned is do something bias. They need to constantly engage in action and look busy and productive. But investing is a field in which success can come from simply reading, thinking, observing the world around you, and doing nothing more than making an occasional phone call to your broker to execute the order. In investing, less is more. And the less money the brokers make, the more money investors make. So basically, you need to reduce your activity. As regards the most insidious behavioral biases which affect investors, I would term recency bias as one. Basically projecting the recent past of bad returns or good returns infinitely into the future. The world is a cyclical place, and everything seems linear till it is not. So we cannot predict the future, but we can definitely understand where we stand in the cycle. That's why having a very good understanding of market cycles is valuable for an investor. Another behavioral bias which affects investors is anchoring bias. You should not just hold on to a stock with worsening fundamentals in the merry hope that somehow things will get better. Always embrace and acknowledge reality for what it is, because the great investors are active seekers of truth. If something has gone wrong with the story, just sell the stock and move on to a better one. There is an endless stream of opportunities in the stock market at all points of time.
Gautam, you interact with some of the top-notch investors globally. Uh, if you were to tell us about one global investor and one domestic Indian investor who has really been very instrumental in influencing the way your thinking has developed over years, who would that be? And if you could tell a little bit about that particular investor and what you learned.
Well, if you just think about the global investors, it has to be Warren Buffett. And over the years, I've come to learn that the best things to learn from Warren Buffett have got nothing to do with investing. It's about living a fulfilling and meaningful life. That is what my book really talks about. That how the actual life of a true value investor. It's about living a life of integrity, principles, and values, and engaging in lifelong learning. That those are the attributes which Buffett has instilled in me. And from India, I would name two investors, Mr. Bharat Shah and Mr. Utpal Seth, both of whom have educated me on the principles of value creation. I'm really thankful to them for all that they've taught to the investor community over the years.
Right. Okay, so one parting word from you, Gautam. If there's one advice you would want to leave our viewers today from Voyage 2021 of ET Now and Birla AMC puts together every year, what would that one piece of learning would be, the gist of the entire experience and research which you've done so far to become a better investor?
Well, I would share not one but two learnings, Ajay, actually.
Sure.
That the great things in life come from compound interest. So take a long-term view and never give up. The second is always learn from everyone else throughout life and embrace everlasting humility to succeed in this endeavor.
All right, Gautam, thanks so much for your presentation and the chat for Voyage 2021. It was really very enriching chatting with you. Thank you so much for your time and for making Voyage 2021 a great success. With that, I'll hand it over to my colleague at Birla.
Thank you, Ajay. It was a pleasure.
Fantastic. Thank you so much for that, Mr. Baid and Ajay, for that great interaction. We all learned a lot. I mean, I'm really now excited to read his book. I haven't been able to get my hand on that. Maybe I should have taken a part in one of the contests today. This brings us to the close of day 2 of Aditya Birla Sun Life Mutual Fund presents Voyage 2021, the rise of a new decade, partnered by ET Now. But it's time to announce the winners. Like I just said, the winners would be getting a copy of Gautam Baid's best-selling book, The Joys of Compounding. All right, first up, the champion of 8th Wonder. If you were wondering what the answer was, the answer is that Ram makes more money by around 74 lakhs. The winner is Ashish Jain, ARN number 149229. So Ashish Jain, congratulations. Our team will be getting in touch with you. The active learner of the day, the one who's been asking the most relevant questions and comments, is Savita Goyal, ARN 24511. Congratulations, Savita Goyal. Our team will reach out to you. And finally, smartest Twitterati of Voyage 2021 on day 2 is once again Joswin J. Menezes. Congratulations once again, Joswin. Just keep all those tweets coming in. We're really thankful to you and to everybody else who's tweeting and sharing their comments here again on day 2. A quick summary of what we've been through today in case you missed any of the sessions. We started off with the DPIM secretary Tuhin Kanta Pandey. He came up and gave some keen insights into the government's divestment plans for the way ahead. He spoke about BPCL, LIC, and even about the public sector banks. So it was a great idea, great inputs that we got so that we also know what the government is planning in the divestment space. Next, we had a real estate panel with some of the doyens of the real estate coming in. They spoke about, how they shared some of the trends that they're expecting to see over the next few years in real estate, both in the commercial and residential properties. One of the important points that they left that was about that it's still not a speculator's market. Real estate is not a speculator's market right now. But if you're buying for your self-use, then go ahead and do buy yourself a lovely house. We then heard from Mahesh Patil, the co-CIO of equity investments at Aditya Birla Sun Life AMC. He shared his research into the equity market and his outlook for the way ahead. The numbers look positive for the way ahead, and even though the markets have been making all-time highs, there is still growth expected. In short, it's still a good time to get into the markets. He also spoke about how the last decade was more for developed markets. And yes, of course, in China was the emerging market star that stood out. But this new decade is for the emerging markets, and it's time for India to shine now. We then heard from the senior portfolio managers at Aditya Birla Sun Life AMC, the senior fund managers for equity investments, who shared their portfolio strategies, which was a great viewpoint for us and to know how they are managing the money, what their view is, and where they are expecting growth to come from. It was also very interesting to note the strategies, how their strategies are different depending on the investing aim of the fund that they manage. It's perfect example of customization in investing. The second last session was the sectoral panel where we had some more portfolio managers from Aditya Birla Sun Life come in and share their views. There was talk about expecting a lot of investments in the tech space. Also, a good point that came up was about the Aditya Birla Sun Life Small Cap Fund, which is a true small cap fund, and how it can help investors achieve their investing goals. One thing that I really liked about it was about how the team spoke about them going through a dedicated and detailed process of identifying a basket of companies that the AMC invests in. And it's a large team that looks into this. So, multiple heads, multiple expertise, multiple levels of expertise going into any kind of investing that they do. And finally, we heard from Gautam Bed, and he spoke about his amazing book, The Joys of Compounding, speaking about value investing and just about the fact of staying in it for the long term. That's only how you will get the benefits of compounding. So overall, in all, a great day at day 2 of Voyage 2021. Tomorrow is day 3. It will be another firecracker of a day. We'll focus on the fixed income side of investing. Today we heard about equity. Tomorrow will be fixed income. We'll hear from Manish Dangi, the CIO fixed income at Aditya Birla Sun Life AMC, along with senior portfolio managers from the company. We'll also have the co-CIOs of the AMC, Mahesh Patil and Manish Dangi, and the fund manager Vinod Bhatt talking about asset allocation, a really, really important part, but you already know that. While we'll also be hearing from leading organized mutual fund distributors in India, and they will share their insights on making the mutual fund industry, the mutual fund growth story inclusive. But you definitely want to be on time tomorrow morning, because we're kicking off with a power pack session where Sanjeev Sanyal, the principal economic advisor at the Finance Ministry, will be charting the course for an Atmanirbhar Bharat in the new decade. So it's going to be an exciting final day of Voyage 2021 tomorrow. Keep the conversation going, keep tweeting, keep sharing your comments with the hashtag Voyage 2021 and the handle @ABSLMF. This is Sumit Lakhotia signing out, and we'll see you tomorrow again. Thank you so much for being here with us.